Business. Every weekday on Bloomberg TV and radio, hosts Joe Matthew and Keely Lines deliver news, insight, and analysis from and about politics' biggest power players.
The president has been clear that is non-negotiable.
I mean, this is going to be an ugly, ugly year.
Balance of Power, live around the world every weekday, only on Bloomberg Television and Radio. Context changes everything.
So many people say the only way to really deal with climate change is kind of eliminate oil and gas and then have more clean energy. Is it realistic to eliminate oil and gas in the foreseeable future?
You actually have to at least mitigate it. I think you have to bring a lot of it down and replace a lot of it, but you also have to, you can also have a huge impact by trying to do things like carbon capture and so forth, right, and around it. And it's going to take both approaches. Even today, greater than 80+% of the way the world operates around energy right now is still fossil fuels, you know, when you kind of look at it. And probably what's more striking is the fact that the demand for it is going up every year.
Things like solar or wind, it's nice and environmentally friendly, but really it's not going to produce enough energy to really replace oil and gas in my lifetime, I assume, right?
Well, not by itself. So let me just say, solar and wind are critical components. You need, this is going to be sort of a collective effort with a lot of different technologies that are each going to come in and take their piece. But we do a breakthrough. We look at technologies that could produce half a gigaton, remove half a gigaton of carbon a year. And the way to think about that number is we have to remove, say, 100 half a gigatons, you know, a year in terms of what we have to replace.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. How has that shaped your strategy for the bank? Is this a new normal? Is this like a catalyst? Do you think we're in a new phase for dividend policy overall? That's a great question. I'm Francine Lacqua, and this is The Pulse, every weekday only on Bloomberg.
Key driver for U.S. equities has been earnings, and that has been driven by large cap tech and the AI trade.
We still like the big tech. They have delivered on the earnings front.
The biggest driver has been the big tech companies, and that's also where the big earnings have been as well.
In the near term, I kind of like banks. I like some of those other sectors maybe to benefit from this Goldilocks.
We're very optimistic for a very improved mergers and acquisition and equity underwriting market for the rest of this year.
This is Bloomberg Surveillance with Jonathan Farrell, Lisa Abramowitz, and Anne-Marie Hordern.
The second hour of Bloomberg Surveillance begins right now. Live from New York City this morning. Good morning, good morning. Plenty to talk about. Let's begin with the Walt Disney Company in the pre-market. That stock is lower by around about 4 to 5 percentage points in the pre-market, following a decent run of gains year to date. Yet today, the stock before today was higher by 29%. A little bit softer this morning, Bramo. The numbers, though, pretty decent. It's a beat on earnings. It's an upward revision to the outlook. And the losses in the streaming business appear to be narrowing.
At a time when people still want to go to the parks, they still want to go on Disney cruises, and Disney's shown pricing power to be able to raise prices to offset some of those losses. They also said that they're going to increase their guidance for full-year growth in earnings per share by 20 to 25%. So far, a lot of the gains have come from cost cutting as well as just sort of a refocusing What will the additional gains come from? I'm really looking forward to hearing from the CFO on that.
And you have to think then, why is the stock down this morning? And I just look at this $2 billion impairment charge they took, and potentially that was what is weighing on the stock this morning. Because to John, to your point, they beat estimates and narrow in terms of the losses in streaming TV businesses, higher ticket prices, and you see this demand for these experiences at their theme parks. So why are we seeing a little bit of pressure on that stock?
It's the consumer price tolerance I'm interested in. We've heard from so many different companies around the consumer, both at the high end and the low end. And I think what we've heard repeatedly, Lisa, is upper end stability and lower end fragility. We've had guests that have basically said those words. The theme park business just seems to be booming at a Walt Disney Company.
People still favor experiences. The post-pandemic lure of just existing in the world and not necessarily through a screen or just buying goods has persisted. How far can that go? What more can they add? I would just argue that there is this one sort of question mark also, which is that the streaming numbers didn't come in quite as high as people had expected for Disney+. So what is going to offset it on the other side at a time where consumers are willing to spend on the experience? Are they willing to spend on the streaming, on the sort of visual at home?
That stock is lower by 4%. The broader price action, if you are just joining us, welcome to the program. Equity futures on the S&P 500 positive by 0.05%. 3 days of gains on the S&P coming into Tuesday in the bond market. Yields rally, yields drop once again for a 5th consecutive session. We're lower by 2 or 3 basis points on a 10-year to 446.10. Coming up this hour, we'll catch up with the Disney CFO, Hugh Johnston, reacting to the company's second quarter results. Alex Cheloff of Bernstein, as stocks look for a 4th straight day of gains. And U.S. Marine Corps veteran Elliot Ackerman as his ready troops take control of the Rafah border crossing. We begin with our top story. Disney reporting fiscal second quarter profit that beat estimates thanks to sharply narrower losses in its streaming TV business and higher ticket prices at theme parks. I'm pleased to say that joining us now for more is the Disney CFO, Hugh Johnston. Hugh, wonderful to catch up with you once again, sir. I want to begin, if we may, talking about the theme park business and the consumer price tolerance that you see. Do you still have that pricing power at a time where many companies are reporting that, yes, there is upper end stability, but maybe some lower end fragility around the consumer?
Yeah, good morning. Great to be with you all. Yeah, I actually believe we do. If we sort of zoom out a little bit, the quarter was really a strong one for us. 17% OI growth, 30% EPS growth. That's what led us to raise guidance to 25% EPS growth for the full year, which is obviously quite strong. 2 big stories, I think, here. Number one, you were just talking about our experiences business was up 10% on a revenue basis, 12% on an OI basis. And the parks business was actually up 13% on OI. So we do feel good about that. Obviously, I watch other stocks report and have seen that the value consumer is really struggling a bit and making choices right now. We're not really seeing as much of that in our portfolio of products. The other positive for us is obviously the streaming service. Last year, we lost about $600 million. This year, we're about break even, and we saw 12% revenue growth. So we're encouraged by the progress we've made in that business in a relatively short period of time.
Hugh, you said that you're not seeing that kind of price sensitivity. How much could you increase prices then from here?
It's a great question. We took prices up a little bit in the beginning of this year and didn't really see much of an impact. So as to what the future brings, we're obviously very judicious with the way that we price. We want to provide access to as many guests as we possibly can. But we do believe that the great experiences we provide, people are willing to pay for.
Hugh, let's talk about the streaming business just a little bit more, and more specifically, if we can, Hulu. I want to get into Hulu and the future of that business. Can we just start with something like the likes of Taranaga and Shogun on Hulu? Hugh, how impressive that content actually was. When you have something like that, a big hit, how does it translate into gains for the company? How does it fall to the bottom line?
Yeah, it really does create 2 things. Number one, it brings new subscribers in, right? We call them first subscribers. Those types of shows do pull people into the service. And then once they're into the service, they realize just the great amount of content that's out there, so that those shows also tend to increase stickiness over time. So from both perspectives, they're truly additive. And the other piece of it that's terrific, I think, is it really does integrate well with the linear business as well. So, you know, we use these different windows to choose when to show things, whether it's on FX or whether it's on ABC and then into the streaming service. So we're actually getting quite good at reaching different audiences, streaming being a bit of a younger audience, the linear business being a bit of a more mature audience. It gives us the ability to reach the most people, which is obviously terrific from an advertising and a subscriber perspective.
That sets up brilliantly the conversation about the future of Hulu, Hugh. So let's talk about it. A report yesterday from Reuters that JP Morgan has valued the company for you at close to $27.5 billion. Morgan Stanley valuing Hulu for Comcast at more than $40 billion. Is that an accurate assessment of where things are? They also reported that we're looking for an independent valuation now to try and close the gap. Could you just update us and tell us if that's an accurate representation of the current state of affairs?
Yeah, so we have a well-defined process in terms of how this is going to play its way out. Beyond that, I'm not going to comment on that right now. One of the disciplines I have is I talk about M&A when it's done, not before it's done.
Too early to talk about a timeline, Hugh?
A little bit too early.
So, Hugh, let's talk about going forward from here, where the big opportunities are for the streaming business.
Look, I think there are a multitude of opportunities. Number one, great programming, and that's an advantage that we have in our Disney portfolio because we create so much of our own IP. Number two is driving engagement, and bundling clearly does that, whether it's with sports, whether it's down in Latin America, we're actually putting sports, general entertainment, and Disney Plus together, or the tile that we added, the Hulu tile on Disney Plus. So that bundling is clearly an opportunity. Third is password sharing. That's an opportunity for us. We think it's pretty substantial and it's going to drive growth. Fourth is distribution cost. We do think by going direct to consumer, we can actually both build a stronger relationship with the consumer and also reduce our cost. And then fifth is technology. Clearly an opportunity in terms of recommendation engines. As we put all of that together, we're pretty well convinced that this is going to be a great growth business for the Disney company for a long, long time.
Hugh, you mentioned a number of things there, including password sharing. How much do you expect all of those initiatives you just mentioned to save money? What's the cost benefit of all of that?
Yeah, I mean, things like password sharing obviously drive additional revenue growth. Things like distribution costs do save money for you. In addition to that, things like recommendation engines and direct-to-consumer marketing tends to reduce churn, which allows you to reduce marketing costs. So there really is some synergy between the revenue benefits and the cost benefits. But overall, look, we're looking to make this into a great business, not just a growth business, but a great margin business for the company as well.
Hugh, over the past 6 months, we've been talking about the cost-cutting operations in Disney. Have we finished some of the shrinking? Have we finished the paring back? And are you back on some sort of growth trajectory?
We are definitely back on a growth trajectory. That said, we're always going to be looking hard at our cost structure, in particular looking to reduce costs where perhaps they add less value than they used to, and redeploy some of that money back into the business so that we can actually grow the balance of the business. So I think that's a never-ending exercise of looking for ways to be more efficient as a company so that you can invest in your future.
When you talk about growing, where is that growth focused on geographically? We know that in the U.S., you've got a very strong parks business. In Europe, there also is a parks presence, but in Asia, in particular in China, that has been a growth area. Is it still, how much can that be a bright spot at a time of increasing geopolitical tensions?
Yeah, I do think not just China, but all of Asia represent growth opportunities for us, both in terms of the streaming service in select markets, as well as in terms of the parks and cruises business. So we do see good growth opportunities there. Europe and Latin America continue to be good growth opportunities. And make no mistake, North America, we're not done growing yet. We still think there are terrific opportunities here for us right at home.
When it comes to Asia Pacific, is it domestic demand within those countries, specifically China, or is it tourists in the region?
Combination of both. I wouldn't tie it to one or the other. I think it's a combination of both.
And when you look at China, to Lisa's point, you know, we're going into a very heated political election coming up in November, very hot rhetoric regarding China. Is it becoming more challenging to deal with authorities in Beijing and business on the ground, given the increased geopolitical tensions?
It has not been for us. You know, one of the benefits of what we do for a living is, you know, we make people smile. We bring them happiness, right? We bring them the most magical place on earth. Candidly, the government's investing in infrastructure to make it easier for guests to get to and from the park. we're continuing to invest in that park in order to drive growth. It's doing better now than it ever has. So we're the fortunate beneficiaries of bringing people joy in a world that needs it.
Hugh, we've got to talk about the NBA deal as well. Can you talk to us about that? And if it is going to be much higher, how do you make money from something like that? I just want to understand the numbers business of all of this.
Yeah. So the NBA, we're in the middle of discussions right now. So again, I don't comment on specific deals until they're done. What I would tell you is two things. Number one, we've had a long productive relationship with the NBA. We've benefited from it, and clearly the NBA has benefited as well. I expect that that'll continue. Number two, we'll always continue to look at the balance of our rights portfolio, and as things come up, we'll decide whether we want to continue with them in the current form, reduce them, or even in some cases, perhaps not continue to carry them anymore. So I think we'll balance the portfolio of rights, and we'll get the things that we need as the 35% market shareholder in the sports business to continue to make ESPN the true leader in sports.
Hugh, you said you won't comment on deals until they're done, but maybe you'll comment on other people's deals. Can we do that? Sony, Paramount. How would that impact Hollywood? Is that something you'd oppose?
You know, it's funny. I don't have a real comment on that one.
I didn't expect you to, but we have to ask Hugh. We've got to leave it there. It's good to catch up, sir. Hugh Johnson there, the Disney CFO, on the latest earnings. That stock is down by about 5% this morning, but up on the year. Year to date before today, higher by about 29%. Theme park business, there is pricing power. Losses in the stream business seem to be narrowing. What is happening elsewhere? There's a lot of things that Hugh still can't comment on. There's a lot of deals that still need to be closed. Hulu is one, media rights with the NBA is another. There's a lot of stuff they need to work through for the year ahead.
Also the potential for Paramount and what happens if they do get bought by the consortium of Apollo and Sony, what that does in terms of the competitive landscape. There's a real question going forward about what media looks like, and we haven't shaken that out, and exactly where Disney fits into that is going to have to be determined by the landscape.
Stock a bit softer on the session in the pre-market. Let's get you an update on stories elsewhere this morning. Here is your Bloomberg brief with Danny Berger. Hey, Danny.
Hey, John. In a speech today, President Biden plans to denounce anti-Semitism at college campus protests. He'll be delivering the keynote address at the U.S. Holocaust Museum's annual Day of Remembrance. That's at 11:30 a.m. in D.C. The speech will underscore Biden's political dilemma 7 months into Israel's war in Gaza, expose divisions within the Democratic Party that can complicate his odds of winning the November election. Now, relatedly, college campuses across the country are still grappling with pro-Palestinian protests. Columbia University has called off its main commencement ceremony yesterday, less than a week after calling in police on demonstrators. Harvard and MIT are warning students to leave their encampment or face suspension. Now, some good news, long awaited perhaps, for the bond desks. Bonuses are set to swell this year. Bankers who underwrite debt might see payouts grow as much as 25% this year. That's according to a report from consultant Johnson Associates. For the bond traders and equity underwriters, bonuses may rise 20%. As for the industry-wide figure, still a ways off the soaring payouts that we saw in the pandemic deal-making era. But the consultancy firm said that Wall Street is entering a phase of more sustainable growth. And that's your Bloomberg brief. John.
Danny, thank you. We'll touch base again with you in about 30 minutes' time. Up next on the program, traders once again looking for that big rotation.
We've had the bull run from U.S. equities driven very much by tech and the AI story. From a more tactical view, we are potentially seeing a bit more convergence.
A conversation just around the corner, live from New York this morning. Good morning.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
In a multi-trillion-dollar industry, there's a lot of ground to cover.
Bitcoin ETFs rubbing elbows with the big dogs.
This frenzy has engulfed the entire world.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, only on Bloomberg.
Equities on the S&P 500 just about unchanged this morning following a three-day winning streak on the S&P. In the bond market, yields lower for a fifth consecutive session. We're down 3 basis points on a 10-year, 445.90. Under surveillance this morning, traders looking for the big rotation.
We've had the bull run from US equities driven very much by tech and the AI story. And I think that's a secular theme that makes the US stand out on a structural basis. But I think from a more tactical view, we are potentially seeing a bit more convergence, a bit of a catch-up trade from some parts of the market that lagged.
Here's the latest this morning. The S&P 500 on track for its best three-day run this year, with investors looking out for opportunities across the broader market. Alex Shaloff of Bernstein writing they're, quote, big fans of the market broadening out, not only as stock pickers, but as a leading indicator. We look back over time at periods of when concentration gave way to breadth, and the results are good for the economy and for markets too. Alex is with us around the table. Alex, hello to you.
Good morning.
Why do you think this could be durable? Maybe this broadening out, this catch-up trade elsewhere?
Well, I think everyone was so concerned when the Mag 7 started to weaken. Our view is we've been waiting for it for a while, and actually we're gratified to see a lot of the other forgotten 493s start to come up. And so our view is that a broader market is better for the economy. It is better for long-term durable growth in the S&P. And it just signals the fact that investors aren't focused on a small subset of companies, but really focused on broad market opportunities.
Does this extend to small caps as well? Because we've had a couple of head fakes. April was just absolutely dreadful for the Russell. Why does this get better?
Yeah, I think if you tell me where the economy lands and inflation lands and where rates end at the end of the year, then I can tell you what small caps are going to do. Small caps are extremely dependent on a U.S. economic expansion. It's hard for them to do well when the economy is bouncing around. Our view is we're not in recession. We don't think we're going into recession, but it's been hard for small caps to break out because there's been a lot of uncertainty around it.
It's also been that yields have been higher than a lot of people had thought that smaller companies can really sustain, and that they're more interest rate sensitive. There's concerns about the debt. How much is your bet on a broadening out predicated on an idea of a Fed that can cut rates in the face of immaculate disinflation?
I don't think the Fed needs to cut rates as long as they don't hike rates. If we hang around here at the current levels, our view is the 10-year finishes the year at 4.25, not that far off from where we are today, then we'll be fine in the markets. It'll be a grind. It's not like it's going to be a rock star 2024 like it was in 23, but we will grind higher from here, and we think there's upside.
And this is going to come not necessarily in the face of weakness, but just simply the normalization, right? Because there's a distinction. As John has mentioned many times before, not all rate cuts are created equal.
Yeah, I mean, it's been a while since we've seen a rate cut that's occurred when there hasn't been an emergency, when there hasn't been the house on fire for them to cut rates. And so, you know, there's not a lot of people that remember the last time we cut rates when everything was fine. And this is going to be the first experience in it. I think what you've seen is, though, investors are waiting and waiting and waiting and just can't wait to get to the other side where we will actually have that first cut. And our view is it's December. But look, it's May. And so maybe December, the next time I'm here, I say, oh, we never said December. It was actually March. So our expectation is that rates stay where they are, potentially a cut at the end of the year, and that's supportive for markets.
A measure of waiting and waiting and waiting is the cash and money market funds. I basically look at that, and it's sort of the market measure of just how many people are waiting. It's more than $6 trillion. People are still waiting. Is that sort of the signal that you see, that basically this is the time when you're going to start to see some of those money market funds come down as people deploy?
I wish that I could say that would occur. The math is reliable over multiple periods in history. If you are invested out of cash and into something that has a little bit of duration in fixed income markets, you do much better 6 months in advance of the first rate cut. But I have to tell you, I think this one, investors are going to be late in general. I think they're going to need to see, like actually the announcement come out, we are cutting, and then they'll say, oh, let me move my money market. I don't think, there's not a lot of appetite to move in advance, even though the math says you absolutely should.
Can we talk about pricing power? Disney's down this morning by 6%, up on the year before today by close to 30%, so decent run for them. Pricing power of the theme park business, not what we're hearing elsewhere with the consumer. We're hearing a loss of pricing power, maybe pushing towards that time where margins start to get squeezed, you need to defend them, you need to lay off people. How close do you think we are to that big moment in this economy?
I think that companies today broadly are being much more careful with costs. I think they recognize that turning the dial really after inflation has peaked is harder. You know, a year or two ago, it was easier to raise prices. I spend a lot of time flying across the country, and I watch not a terrific barometer, but it is a pretty good evaluator on where we are in pricing power. There are still industries that have it. And it's not as if once we come over this peak that we think we've already reached in inflation, that we're going to be in deflation. Prices aren't coming down from here. They're just not going up from here. So I think companies are now fine-tuning their cost structure to allow for them to continue to be as profitable as they are. I mean, we're having a pretty good earnings season right now. And I think that was, that was the expectation, but not as good as we've had. And our expectation is that continues for the rest of the year.
A ton of beats. You mentioned some industries where there was pricing power. Which ones?
Well, I think it's still in discretionary spending where there is household balance sheet strength. That's paying off in additional spending. I think you'll continue to see that. So, travel and leisure has been volatile. It's bounced around, but I think that's going to be the case. We get excited about AI and the AI revolution. And yes, there are those companies that we view as enablers in the AI space, and they've definitely been able to change pricing. But there's also the AI beneficiaries that are on the other side that will perform better, be more productive as a direct result of AI. And we think they'll be able to command higher prices as well.
So what are you staying away from, since you seem to like a lot?
Well, I think you have to be careful about areas that I point to companies that have done exceptionally well without the earnings. So there's a lot of hope that has occurred in this market. That's a big part of what happened in 2023. A lot of investors made bets, I'll say, on companies on the come, thinking they would deliver. And as we've seen, there's been some wobbling in earnings in those names. So I would say we're very focused on reliable, transparent earnings where we've got good visibility to the next few quarters and staying away from the hope trade.
There is this question, though, about how much companies are controlling costs. We've seen earnings per share come in better than revenues, and this has been pretty consistent. And this is sort of the predecessor to cost cutting in a more significant way. How far will that go? Will that go to jobs? Will that go to other areas? Is there anything left to cut?
I think there still are areas to cut, broadly speaking. Now, having said that, you've seen the jobs numbers stay strong. I said about the jobs number on Friday, it was as perfect as one could be. It was, I don't have an emoji for Goldilocks on my phone, so I was sending a bunch of 3 bears, but I think this is exactly what we're looking for. So I think you still can see some companies letting some people go or shrinking costs, but them getting scooped up pretty quickly. It's still a pretty tight job market out there, and that's frankly one of the key indicators that we're not going into recession. You don't go into recession when you got a job market like you have today.
Still pretty impressive, around 175. Alex, thank you, sir. Alex Shaloff there of Bernstein. Later on today, we'll catch up with Mr. Zandi of Moody's. A couple of questions I have with him about border crossings. So many of economists have come on this program and talked about the supply side boom that we've seen. People crossing the border, taking jobs in America, giving life to that 200K kind of theme that we've seen in payrolls without wage growth taking off. We had a report yesterday that border contacts have dropped, and by quite a lot. And what I'd like to know is, okay, if you believe that was what was holding back wages before, what do you think this is going to look like in 3 months, 6 months, in 9 months' time?
If this is a supply-side driven response, if that supply side stops being the response, how much do you see sort of the real wage pressure come back into play? It's a great question. It's something people have been asking. How much is this a consistent given that can continue for a long period of time?
Mark Zandi, the chief economist of Moody's, joining us at around 8:30 Eastern Time. Coming up shortly, we'll catch up with former White House fellow Elliot Ackerman. He's going to be joining us very shortly on the latest in the Middle East. Equity futures right now on the S&P 500, just about unchanged. Disney near session lows. That stock is down hard in the pre-market. It is negative by something like 6%. From New York, this is Bloomberg.
or other authorities.
Could face bigger challenges next.
Fed was going to keep rate World Cup. This is a 3
As the economic picture
covering the intersections of Hollywood, Silicon Valley, and beyond.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Equity futures just about unchanged on the S&P 500. On the Nasdaq, we're negative by 0.2%. On the Russell, the small caps up by 0.1. A single name, the Walt Disney Company, down pretty hard at the pre-market, off by about 6% in the last 5-10 minutes or so. Let's switch up the board and turn to the bond market. 5 days of yields falling on a 10-year, down another 2 or 3 basis points to 4.4590. Over those 5 days, we've had a move of more than 20 basis points lower, basically peaking around that ECI print, the employment cost index last Tuesday, coming in a bit hotter than expected. Since then, Bramo, that move has faded and faded hard.
The market was expecting a Fed pivot. They didn't get it, so it went back to the way that it was before, which is essentially this is a Fed that wants to cut rates. It's just a matter of when and when they get enough evidence. Now, the question really is just how much are we swinging to the other way, to the other side? That now that the threshold to cut has gone down so dramatically simply because, well, I don't know why. Maybe we got a couple of prints that were a little bit softer than expected.
ISM was soft, payrolls was soft.
It's enough.
CPI next week, May 15th. We'll see where we are then. Pendulum all the way back to the other side. I mean,
That's
who knows?
where we're at.
Who knows? Who knows? Let's turn to foreign exchange. Let's talk about the politics of dollar-yen, because it's very political right now. 154.43, currency pairs positive by a third of 1%. So what you see on the screen is a weaker Japanese yen off the back of this commentary back and forth between US officials, Janet Yellen, and Japanese officials out of the Ministry of Finance.
Well, Yellen said that when they are going to take under intervention, she expects consultation. She also expects interventions to be rare. Then she said these reports are rumors, which makes me think that the Japanese did not call a treasury and alert them and consult with them that they were going to intervene if she's saying, well, what I know right now is that these are just rumors that are happening in the market.
Why would they? I'm sorry, but at a certain point, just viewing this from the rest of the world, what hubris that the U.S. says, you know, why didn't you give us a call and tell us ahead of this? Because basically, a lot of people are saying that this is a drop in the bucket. This is just trying to stabilize the yen. It's not like they're trying to manipulate the currency for some sort of trade dynamic. This is just simply a way to stabilize something that has gotten a little bit ahead of itself.
Well, they have an agreement at the G7 to only intervene under certain circumstances and for there to be some kind of correspondence between all the interested parties.
You know, a lot of this rhetoric, I kind of just shrug off, because at a certain point, Janet Yellen can also say, hike rates. Well, that's a legitimate question, right? Why aren't they doing that? But then there's this other issue of what more can they do? Honestly, how effective was this intervention given how weak the currency is at the weakest levels in more than 3 decades? So at a certain point, okay, how much can we get really jazzed about this?
It just feels like they're trying to stave off that 160. That seems to be the new line in the sand for the Japanese.
I remember when the line in the sand was 150 and then 152, and that was all in the last month. So here we are at 154.39. Under surveillance this morning, more Fed speak on tap today following comments from New York Fed President John Williams and Richmond Fed President Tom Barkin saying that current monetary policy is restrictive enough to get inflation to the Fed's 2% target. Minneapolis Fed President Kashgari speaking to Bloomberg TV at 1:15 this afternoon. Kara Massa, Romain Bostic sitting down with him. Don't miss that. 7 more speakers on deck later this week, including the Vice Chair Jefferson. I want to go back to a quote of his from way back in April, when the Vice Chair of the Federal Reserve said this: "My baseline outlook continues to be that inflation will decline further with the policy rate held steady at its current level." I think that statement has stood the test of time. That is the ultimate position of this Federal Reserve. We keep rates at the current level, and if we need to, we keep them there even longer.
Which is not what this market is looking for, and frankly doesn't go to this idea of a bias of a rate cut. It goes to the bias of holding, and this market doesn't like holding. It wants a move. You either go down or you go up, or you don't just stay the same place, which you know, again, if he says that, does he take rate cuts off the table for the foreseeable future, even though you have the likes of John Williams coming out and saying, we're going to make a cut, it's just a matter of when?
The emphasis is on time, and as our good friend TK would say, extend the x-axis, which seems to be what they're doing over the last 12 months or so. That's the story then for the Federal Reserve. Much more on that a little bit later. I want to talk about Disney reporting second quarter earnings that beat analyst estimates thanks in part to narrower losses in the streaming business and higher ticket prices at its theme parks. The company also raised full-year guidance for earnings growth per share to 25% from 20%. Not enough to satisfy a lot of investors this morning, apparently. The stock is down, Anne-Marie, by more than 6% after a pretty stellar run year to date.
Stellar run in the streaming business turning a profit. And this has to go to the likes of people like you, Jonathan, watching Shogun, maybe not The Bear, but these were the shows that people were then signing up, streaming Disney. Across the board, some pretty good numbers, yet the stock is a little bit lower than expected. I think a lot of this has to come down to the goodwill impairment. It took more than $2 billion.
A lot of people pointing to the subscriber numbers on Disney+. They came in short of estimates, 153.6 million versus the estimate of 155.6 million. How are they going to grow it, right? Do they have pricing power in this particular service? And can they grow? And if they can't, what's the future of this? Is it just to sell off different pieces of this? We're not really getting clear answers on exactly how they're going to go about doing that.
Streaming is a really tough business right now, really difficult. It's very different to where it was back in, say, 2020 when this initiative really took off. We'll catch up with Steve Eisman a little bit later. Steve was on a podcast, Odd Lots, with Tracy Alloway and Joe Weisenthal, and he said in good times, you talk about stories. In bad times, you focus on balance sheets. 2020 was good times for streaming. Yeah. 2024 is bad times.
Which is the reason why you've seen so many discussions around consolidation, which raises this question of, okay, how are they going to consolidate? Are they going to sell things off? Are they going to acquire things? Right now, the focus is not on expanding their base of subscribers. It's on password sharing. It's on some of these other revenue drivers. How much can you then bank on that, and what price points can people expect in terms of what they're paying for their services?
Stock is lower by about 6% in the pre-market. A final story here, Israel moving forward with its plans to take the Gaza city of Rafah. Hamas saying all moving of people and aid stopped at the crossing from Egypt. This coming after Israel rejected a ceasefire agreement from Hamas, saying it was, quote, far from Israel's necessary demands. Elliot Ackerman, U.S. Marine Corps veteran and former White House fellow, joined us now for more. Elliot, we've talked in the past about the nature of combat in Gaza. How different will it be if they become more aggressive in places like Rafah?
Well, I think as this offensive proceeds, what we're naturally going to see is that Hamas will have its back increasingly to a wall, and the nature of the fighting could very well become much more desperate and much more aggressive. But conversely, the Israelis are, very much on the clock, getting to a point where the international community needs to see some type of, for lack of a better term, light at the end of the tunnel here.
Elliot, this morning in Axios, it says Israeli officials claim the Biden administration knew about the latest hostage and ceasefire deal proposal that was negotiated but didn't brief Israel before. And then it goes on to say this episode created deep disappointment and suspicion among senior Israeli officials. How divided right now do you see the Biden administration with Netanyahu and his war cabinet?
Yeah, I think tensions could not be higher. President Biden, as we're seeing on college campuses around the United States, and as we're heading into a presidential election in the fall, is paying a very real political price for the war that's going on in Gaza. So, for President Biden, it's not just an abstraction. I mean, his existence and his second administration could in many ways hinge on getting some type of resolution in Gaza. So tensions are very, very high, not just internationally, but domestically for Biden in the political angle here.
When you look at that deep pressure that the international community is placing on Israel, and then you see that Israel, even yesterday, when they said that they will not accept this deal, but they want to seek an agreement, and we do know their mediators, including the CIA's Bill Burns, will be in Egypt today. Do you think we can get some sort of agreement?
It's to be seen. I mean, listen, in any conflict, ultimately, you only get an agreement when both sides choose, or when both sides realize they have more to gain by negotiating than by fighting. And Israel, at this point, does not feel it has more to gain by negotiating. It doesn't feel it's going to get all of the hostages released, and it feels that Hamas still represents a threat that is untenable across their border. I think with regards to Hamas, they would like to negotiate, but only up to a point. So we're seeing that mismatch in realities, and having a negotiated settlement to this conflict necessitates that both sides decide that they no longer have more to gain by fighting. We're just not there yet. We were speaking with Norman Rule, a former intelligence official for the U.S. earlier this morning, and he said all the pressure right now has been on Israel. There hasn't been that much pressure on Hamas. Do you agree with that? Absolutely. I think that, what Hamas and their allies, particularly Iranians, have done is they've done really an exceptional job of bringing the war to everybody's doorstep in the international community, making it probably, the number one issue that's been running in the U.S. news the last week to 10 days with these college campuses. And that, Hamas has not had the same type of pressure. Israel has not been able to drive the conversation. I mean, just look at the disproportionate amount of just media coverage to these protests in the U.S. versus media coverage on the fate of the hostages. That's not an indictment of the U.S. media. It's more just evidence of how Hamas has done a better job steering the conversation in a way that's put a lot of pressure on Israel and Israel's allies. It's not new to have media as sort of another front of different wars and sort of trying to skew public opinion, but it feels slightly different in terms of how it's being distributed. Do you have a sense of kind of what's driving this, how Hamas has gotten the upper hand in driving the narrative? I think it's, it's really a confluence of events. There's been a lot of conversations about higher education in the United States and types of macro narratives that have been fed into U.S. educational institutions for decades now. And I think we're seeing many of those chickens come home to roost in this conflict, in that, you have a mediascape that is initially a priori going to be more sympathetic to Gaza and more sympathetic in a way that favors Hamas. I think that really the seeds that they've planted over years are bearing fruit right now in ways that might be surprising for Israel and Israel's allies who haven't paid as much attention to kind of this long game of public opinion. So it'll be interesting to see post-war whether Israel and Israel's allies wake up to that.
Elliot, I just want to sit on that Hamas, a designated terrorist organization in the United States, is doing a better job of steering the conversation than Israel is. Elliot, what does that tell you about the situation? Is it Hamas steering things, or is it just the situation on the ground in Gaza that's doing that?
Wars are always fought in two places, right? They're fought on the battlefield, but they're also fought in the realm of public opinion. And I think what we're seeing is a real disconnect. So on the one hand, where Israel certainly has they have the advantage on the battlefield, we're seeing that is in the narrative, or at least in certain segments of Western culture, that Hamas very much has the upper hand because, they are the ones who are presenting themselves as the victims here. So, I think we just have to be cognizant about that. It's, counterinsurgency, it's often been said, is like trying to eat soup with a knife. It's very, very squishy trying to win these wars, not only on the battlefield, but also trying to win them in the realm of public opinion. And that's what we're seeing right now.
Some might say it's impossible. Elliot, thank you, sir. We appreciate your time. Elliot Ackerman there on the situation on the ground in Gaza and the war between Hamas and Israel. Let's give an update on stories elsewhere. With your Bloomberg brief, here's Danny Berger. Hey, Danny.
Hey, John. Emirates chairman and CEO Sheikh Ahmed bin Zayed Al Maktoum has told Bloomberg News that the airline is not pleased with Boeing's production delays.
When it comes to Boeing and what happened, I think you are referring to the 777X and the delay that we see. I don't think we are happy, and also all the others who signed up for this aircraft. I met up with the new management just recently to touch bases. They promised that they would be able to change things and make things go faster, and I hope so.
Al Maktoum also went on to say that the airline is also having issues with engines on certain Airbus models. Nintendo has announced a new gaming console that will succeed the current Switch console. Both fans and investors have been waiting for news of a new gadget because the new Switch has lost ground to newer PlayStations and Xboxes. In a post on X, Nintendo's president said the new device will be unveiled in the coming year. Also, today, Nintendo forecast a bigger than expected profit decline for the current fiscal year. Now, the probe into Tesla's autopilot feature is escalating. Regulators are seeking detailed answers on the recall of autopilot, which was originally issued after users kept crashing while using it. In a letter, the National Highway Traffic Safety Administration said it had several concerns regarding the recall and wants data on the performance of cars both before and after the recalls were issued. Tesla has a July 1st deadline to respond. That's your Bloomberg Brief. John.
Danny, thank you. We'll touch base with Danny again in about 30 minutes' time. Up next on the program, it's a data-dependent Fed.
If you provide no forward guidance, the market's going to over-extrapolate from every single data point. And we're going to see this over the next couple of weeks. This market's going to keep swinging around, but at the end of the day, if you zoom out, I think the valuations are quite attractive.
That's the latest on the bond market. The rally continues. Yields falling for a fifth consecutive session. Equity markets pulling back just a touch on the S&P. From New York, this is Bloomberg.
The top names in tech are on Bloomberg.
There is a natural tension between the need of a supplier to scale and the need of the customer, the car maker, to differentiate, try to make something that is unique.
We have a long-term partnership with Tesla, and it's still strong, but Tesla is not the only partner that we're seeking, and we want to diversify and really make the EV market in general stronger and sustainable.
All these devices becoming smart devices, they all need a brain inside that helps them learn what to do. That brain inside is ARM.
I'm believing the next user experience is going to be based on Gen AI on their phones. We're optimistic that we could start to see devices as early as this year.
Our job is to provide great index products and then to be the listing exchange for those index products that allow investors to invest in all sorts of tradable instruments, including now Bitcoin.
Nobody covers technology like Bloomberg. Context changes everything.
This is Bloomberg News Now.
News when you want it at the touch of a button.
Another volatile day on Wall Street. We're seeing big moves.
All eyes on Capitol Hill as Democrats and Republicans prepare.
Today's job numbers casting doubt on the Fed's next move. Inflation remains front and center. And that's news when you want it with Bloomberg News Now. Get it 24/7 on the Bloomberg Business app, Bloomberg.com, and anywhere you get your podcasts.
Bloomberg News Now. Context changes everything.
Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, context changes everything.
Equities unchanged on the S&P 500, going towards the opening bell this Tuesday morning. Good morning to you. We are dead flat on the S&P. The fall in yields continues, down another 2 basis points on a 10-year, 446.71, down for 5 days. 5 days of yields falling, Bramo. It's been quite a while since we've seen things like that.
Yeah, and it comes at a time when the pendulum seems to be swinging in the opposite direction of 1 or maybe even 2 rate cuts this year. There is a feeling that the data is softening, that maybe people are underplaying how much it's going to soften. The issue that I don't see yet is when does that start to mean equity weakness? When does that suggest something that's problematic for companies versus just simply an excuse to cut? Let's just keep this going.
We talked about this in the labour market. What is a welcome cooling of the labour market and what is an unwelcome deterioration of the labour market? Clearly 175 is not an unwelcome deterioration, but you start thinking about something closer to 100, conversation changes.
It hasn't changed yet. We're still in Goldilocks. Everyone's talking about that. The emoji of 3 bears seems kind of counter to that, but whatever. I'll let that go. You should have a Goldilocks emoji to really make it clear what your message is.
Is that what you'd like to see on Developer Day over at Apple?
100%.
Yeah, Goldilocks emoji.
Put it on your iPads. Yeah, exactly.
Wall Street all wants a piece of that.
It's just going to be the screensaver.
I mentioned the 5-day streak on yields. Longest streak going back to August 2023. Under surveillance this morning, a data-dependent Fed.
If you provide no forward guidance, the market's going to over-extrapolate from every single data point. And we're going to see this over the next couple of weeks. Remember, a couple of months ago, we were pricing in a full rate cut by March.
Yep.
And 6.5 cuts at the peak this year. That's gone down to 1 right before, payroll. So this market's going to keep swinging around. But at the end of the day, if you zoom out, I think the valuations are quite attractive.
So here's the latest. Treasuries edging higher with the two-year yield continuing to retreat from 5% as investors await a speech from Minneapolis Fed President Neil Kashkari later on today. Deborah Cunningham of Federated Hermes writing this: the US economy isn't moving backwards or running in place, but simply in overtime in a game in which cash remains king. 2 cuts are likely the most we will get this year. Deborah joins us now for more. Deborah, Lisa went there. What would it take to unlock that money piled up in money market funds? What are we waiting for?
Well, I think at this point, it takes a cut by the Fed. As was mentioned just in that earlier clip, when we began the year, I think our peak was actually at 6.9 cuts expected in 2024. And we're down to something that's between 1.5 and 2 at this point. And nobody has faith in when that cut is going to happen. So if you bought into that story back in January and you started to extend, you would have lost 5.4, 5.5% in yields from money market funds and gone into something that was lesser in return for a period of time that at this point is now up to half of a year. So I think the actual rate cut has to occur before the change from the safe money market cash return type of trade takes a back seat for some investors. I think from a retail standpoint, the cash will keep coming in because their cash alternative in deposits continues to be something that's much, much less than the 5+% that money markets are returning at this point. And I agree with, sort of the 175,000 is what the market is rallying on right now from a bond perspective. That is certainly not a number that's going to the weak side, and that is not something I don't think with this Fed that's going to be that's going to help them gain confidence that the economy is slowing and that inflation is ticking down to where they want to see it.
You went there. Let's talk about the two-speed aspect of money market funds. You have the retail investors who you think are going to keep coming. You think they're sticky. And then you have the institutions that are waiting for the eyes of the first rate cut to really deploy that cash elsewhere. How fast is that money and how much is it?
I think it's the institutional side probably at this point represents, at least from a flow standpoint, less than 20% of the marketplace. When the 2014 reforms that were implemented in 2016 took place, we had to separate the retail side for funds versus the institutional side for funds for everything but government funds. And that really kind of kept the institutions to be smaller players in this market. They're large in the government space, but that's essentially the place where their cash lies at this point. And that yield is a little bit lower than the prime, and on a tax-free side, the muni also on an adjusted basis. So I think, you're talking about the flows from institutions representing something that's only about 20% of the side of the flows in the total market.
At the same time, it raises a question, where is it headed? If it does leave money markets, does it go into longer duration bonds or does it go into stocks?
I think you've probably got a little bit of both. We've already seen, we also manage micro short funds, which are just beyond money funds. So just, sort of the 6 months to maybe 180 days sort of maturities. Then we have ultra short funds that kind of start at a half a year and go out to maybe 2.5 years. Both of those funds types of flows have started to turn positive. So I think that's, an area where people feel a little bit of comfort extending, yet staying within the fixed income marketplace. But there are others, I think, depending upon what type of equity you're looking at, are comfortable going into more the value stocks, not so much growth at this point, maybe a little bit of diversification into international, certainly still interest in, sort of the tech stock side of the equation. And I think you'll see portions of it go there too.
Deborah, we keep hearing a phrase, and can we sort of interrogate that phrase a little bit? Late cycle. When did this cycle begin? What sort of tells us we're late cycle? Because when you've heard that phrase for the last 2 years, how late are we?
Well, I say that the cycle didn't begin. We normalized. when the Fed started raising rates back in March of 2022, remember, it was off of a zero rate base, basically. So until you got to 2% was normal. So I would call the first 175 basis points of increasing rates that they did more a normalization than a return to a rate cycle. From there, which was probably the beginning of 2023, that's when you started what I'd call the current rate cycle. And I think when people are referencing the rate cycle being long, they're looking at the fact that the last time the Fed actually made a move was over 9 months ago. And generally speaking, that move is expected to be a change. So a change from an increase to now a change to a decrease in rates from the Fed's policy perspective. And normally that doesn't take more than 9 months, and we're past that. So I think you've got a little bit of combination of people thinking the normalizing cycle initially was the beginning of the cycle itself, and I don't think that's correct. And I think that the 9 month aspect, greater than 9 month aspect at this point between when the Fed last moved and now adds to that.
Interesting. With that in mind, then, can we just build on that with one more question? What is the new equilibrium? How do you think about that? What is it?
It's hard to say because that new equilibrium has changed so drastically in 2024. I think the new equilibrium gets us to something that this year maybe has 1 or 2 rate cuts in it. Most, you posted the quotes from a commentary that I did just last week. No more than 2 rate cuts this year. And I think in the end, without the Fed maybe admitting it, that 2% inflation is a goal, but not one that is necessarily that they need to see met, that they could be comfortable if they got to 2.5, if they got to 2 3/4. And in that environment, you're talking about another 100 basis points over that in a short-term rate environment that's, normal. And so you're talking about rates that only need to go from, 5 1/4, 5 1/2 down to maybe 3 1/2, 3 3/4, somewhere in that neighborhood. So less than 200 basis points in cuts.
That's the next big conversation at the Federal Reserve. Deborah, thank you. Deborah Cunningham there of Federated on the latest with the Federal Reserve and the bond market. Ferrari, just getting earnings from them, halted down 5% in Italian trading. The bar for earnings appears to be pretty high this morning for both Disney and Ferrari. Ferrari largely in line, and yet the stock is down by something like 5% after gaining more than 20 year to date.
You just wanted to bring up Ferrari.
I did, yeah.
Okay, you want to buy one?
A 20% decline in Greater China for sales. I'd love to buy one.
You think maybe they can discount that?
Can't afford one,
Hey, are you
Bramo.
going to say that? Please.
Can't afford one, but...
You accept gifts?
You accept gifts?
I accept gifts. Apparently I don't.
Yeah, no.
And just to clarify again for the second time.
Standards
in the last
calling.
week. You were telling me I was paid off by Disney earlier. Like in Hulu.
No,
The price is more than that.
Just looking at your portfolio of businesses, it is about resilience. It's about pressure. It's about women. How does that come together how does it manifest in the deals that you're doing now?
Yeah, it's one of the things that I became increasingly passionate about after I retired, was acknowledging the fact that focus and this performance mindset was a huge asset that I had gained and that I had worked on and perfected for over 20 years. And now working through brands and founders, I just recently announced a collaboration with the Amman Hotel Group where I bring in the best talents in sports recovery and performance mindset in retreats and offering it there to their clientele. Our first one is actually in Phuket in February. So working through what that means, I mean, if you see the stats of Fortune 500 female CEOs, 80% of those women have played sport competitively through their life journey. And all those skill sets that they've built, to me, they were part of this first chapter, right? But how do they now apply to everything else I'm doing? And I'm so curious and interested in how I can bring that to the audience now and make it more mainstream and accessible.
It's It's the world's second largest economy with a growing influence in global affairs. But geopolitical uncertainties, deflationary pressures, and questions about foreign investment linger. Bloomberg, the China Show, brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China. Bloomberg, the China Show. Weekdays around the world right here on Bloomberg. Context changes everything. Today's CFOs are reshaping the C-suite. Bloomberg's chief future officer shines a spotlight on these dynamic leaders.
It's an incredibly fun job, for sure.
We're in the business of leading beyond the numbers.
To me, teamwork is key. You need to identify opportunities and push people.
It's not about how to say no, it's about how to say yes.
Their impact goes far beyond the balance sheet. And on Chief Future Officer, they focus on much more than just revenues and margins.
Today's CFO has to be much, much more than a bookkeeper.
I talk more about culture today than I talk about numbers.
It's not just about debits and credits and digits and dollar signs.
It's a lot more than the profit today. It's building the future of tomorrow.
Get passion, perspective, and more from the Chief Future Officers of some of the world's most influential companies. New episodes this summer, only on Bloomberg. Brought to you by Workday. From the world of politics to the world of business, every weekday on Bloomberg TV and radio, hosts Joe Matthew and Keely Lines deliver news, insight, and analysis from and about politics' biggest power players.
The president has been clear that is non-negotiable.
I mean, this is going to be an ugly, ugly year.
Balance of Power live around the world every weekday, only on Bloomberg Television and Radio. Context changes everything.
We've moved from an environment where the data was too hot to starting to cool down.
We know we are restrictive. The question in everyone's mind is just how restrictive.
What is really remarkable is that the Fed endorsed high for longer, but markets are holding up. We haven't gotten the clearest communication from the Fed. We know that they want more confidence, but what is more confidence? What does that look like?
We've just been so fixated on inflation and the Fed that we're missing this real turn. We could see this gap back to hard landing time.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowitz, and Anne-Marie Hordern.
Usually guests come into the studio and they're really cagey about what we're going to talk about with them. Steve Eisman walks in. Ask me who's going to win the election and I'll tell you. Ask me. So we're just going to skip everything and just go straight to Steve Eisman. This is what's coming up this hour. Let's start with that. Steve Eisman of Neuberger Berman, and why he's bullish on AI-related stocks. Mark Zandi of Moody's on his September rate cut call. We'll catch up with Sheila Kahyaoglu of Jefferies as Boeing faces yet another FAA probe. Don't miss that, but we begin with our top story. Stocks delivering their best three-day rally since November. Steve Eisman of Neuberger Berman saying he's long-oriented on the US market, focusing on companies like Apple that are positioning for the second wave of AI, and he has a ton to say about US politics, which is rare these days. Steve is with us around the table. Steve, good morning to you.
Good morning.
I'm going to ask it then. First question, who wins?
So, caveat first.
Okay.
I'm not speaking for Neuberger Berman. I'm speaking just for myself. Don't want to get into trouble. And what I'm about to say is just pure political analysis. And the analogy I'll draw is to the financial crisis. In August of 2007, the subprime paper market collapsed. And at that point, when you look back on it, the financial crisis was baked. Everything else was completely inevitable. So I think that it is completely inevitable at this point that Donald Trump will win every single swing state and will get elected. And the reason I think this way will unfold is part one of this story is that the protesters in all the universities are becoming the face of the Democratic Party. But that's not 100% at this point. But what's going to solidify it is in August at the Democratic Convention, which is in Chicago, ironically, you'll see all these protesters again, and a lot of them will be screaming and yelling things like not just death to Israel, but death to America, because they can't help themselves. And the country will be appalled. And that'll be it. It'll be over.
Let's say you're right. Crystal ball, dead on. Next question is, what do I do with that information, and when do I put the trades on? And what are the trades? How do you sort of go through that process?
I would say you do largely nothing. because I don't think that whether Trump wins or Biden wins has any real impact on the economy at all. You know, there'll be things that people will want to trade, which I'm not going to talk about because I haven't put on those trades yet. Because it's too early. But there'll be things to do. But that'll just be short-term trades.
You touched on it there, Steve. Can I jump in? That's what I'm interested in. You said it's too early. When is the right time to really think about expressing these as trades?
Oh, I think when in August, when at the convention, when I said happens, everybody will realize that that's the case.
So you said that it doesn't really matter who gets elected.
Yes.
That's fascinating to me because some people are saying that Donald Trump would put on pretty significant tariffs, particularly to China, and that this would increase inflation, sort of de facto, in the United States. I see you rolling your eyes. You can respond in a second. And then at the same time, you're going to have, the tax cuts reinstated.
And cats and dogs will be lying together, and it'll be end of the world and doom, gloom, and whatever.
Well, cats and dogs lying together. Yeah. I don't know. It could be doom, gloom, depending on your view. But what do you make of this? Why do you discount this?
I mean, do I think that Donald Trump would increase tariffs to China? Sure. Do I think that would have a massive inflationary impact in the United States? I think that's ridiculous. So, on the margin, would it impact, for example, I'll give you a company, First Solar. So First Solar sells solar panels to utilities. Now, there are already massive tariffs that are helping them now. Could Trump increase the tariffs or make them longer so that stock would do better? Could be. But, are the price of T-shirts going to go up? Is the price of food going to go up? No. I mean, you have to remember that the United States is of all the developed world, the United States is the most insular economy of any developed world. So the fact that tariffs will go on in China, big deal.
But one thing you recently spoke about was infrastructure spending and how you like all of those trades.
Yes.
What happens to all of that if Trump becomes elected? Because all of that is attached to the Biden administration.
Well, true. But don't forget that the solar tariffs were put on by Trump originally. More than 50% of all the government spending is actually going to red states. So I don't think he's going to want to mess with his own voters. Could there be tinkering at the edges? Sure. Are there enough votes in the United States Senate to repeal the IIJ Act and the IRA Act? They're not even close. So, rhetoric, you'll hear lots of rhetoric about repealing the IRA or changing the IRA, and, stocks will move on that. But at the end of the day, nothing will happen.
So spending will continue.
Yes.
Tax cuts will get extended.
Yes.
Tariffs in the margin will be there.
Yep.
This, to me, raises questions that a lot of people have talked about, which is the deficit not going away at the time where you're going to have to see some of the issuance numbers really start to pick up. You seem to discount that too. You don't think that necessarily.
100%.
Okay,
it's not an issue.
Okay, so you don't think the deficit's an issue?
It's not an issue. Can I tell you why? Look, I'm not an economist. I can only say this, that the people who have been complaining about the deficit, and I like to call them the the deficit people, okay?
Because that's what it sounds like.
Because that's what they sound like. I've been literally been saying the deficit for 40 years.
I know, my
okay,
grandfather.
40 years. Now, look, in my business, being too early is the equivalent of being wrong. But in my business, when you're too early, you're a year too early. You're 2 years too early. You're not 40 years too early. When you're 40 years too early, you probably should just shut up and keep your mouth shut. But I would say this, that the sign that the deficit group will be right is when rates actually go up a lot. Until then, everybody should just keep quiet.
But how do you know when that's going to happen?
Well, you'll see it.
But are we getting close to that
We'll be on the
point?
show, and you'll say, wow, long-term rates went up 50 basis points in one day.
That deficit.
And then they will say,
so natural.
They were finally right after 40, 50 years. Until then, it's not relevant.
Well, but this to me is a real question because people increasingly are focused on this in the market. People who actually can determine what those rates are can send those rates to up 50 basis points in one day.
And are they selling treasuries?
Well,
are rates going up?
There was a time when they were.
They're talking,
so
and they're doing nothing.
So are you basically saying that you are long-term rates because you think that all of this discussion about the deficit is still way too early and all these people are going to be proven wrong?
That's going to become a meme now.
I hope so.
And I literally just made it up.
Well, that's fantastic. It's really good. So answer the question.
I lost the train of thought.
Okay, well, I'm just saying, if at what point do you say, okay, if we think that the discussion of the deficit is overblown, go into long treasuries, buy them, because all the people who are worried about that are going to be proven wrong.
Well, I mean, look, I'm not really a bond person. I'm more of a stock jockey. So, what caused the market to go down in 2022? The Fed raised rates 500 basis points. I don't think the Fed's going to be raising rates. Do I think the Fed's going to cut rates? Maybe. I actually don't think it doesn't really matter, because even if they cut, they're only cutting a little bit. They're certainly not cutting 500 basis points. People like to talk about it on Fed Day as if, Moses came down from Sinai with the tablets, and let's examine whether the 10 Commandments are on there, because we'll look at whether there was a comma removed that's so significant, let's buy the S&P,
He wears a bow tie and he sits right there.
He said, wow, what does that mean?
So then how do you
So you know what? It's not relevant.
Okay, so you don't necessarily see the potential rate cutting cycle as particularly relevant to your stock picking. At the same time, we've seen...
There's no aggressive rate cycle coming of cutting. That would matter. If the Fed's going to cut rates once, twice, to tinker at the edges...
We can live with 5%. Is that the message? We can live with 5%.
We seem to be living just fine with it right now.
Yeah.
The economy's fine, which is, I think, is a surprise to everybody.
It raises an important question. I was listening to the podcast you did with Tracy and Joe. It was fantastic, by the way. And if you haven't listened to it at home, you should do. Odd Lots. And you talked about good times is for storytelling, bad times is for the focus on a balance sheet. Is this a good time or a bad time?
This is definitely a good time.
It's a good time.
And I'll just repeat what I said on that show, because I like it. Is that there are three great themes of our time. There's AI, there's everything having to do with infrastructure, and there's crypto. And I believe in the first two, and I don't believe in the third.
Why not the third?
Look, there's two questions with respect to crypto. Is it a currency? And if it's a currency, should you own it? So let's skip the first part, but that's like is it a currency is like having a discussion about how many angels dance on the head of a pin. There's no structure to it. So, okay, so if it's a currency, why should you own it? So let's ask the people who own crypto, why do they own it? They all say the same thing. They say, fiat currency, oi the deficit people. It's definitely going to be a meme.
We're trying.
I created my first meme.
Not yet.
And it's a hedge against the demise of fiat currency. Cats and dogs one day will lie together. You'll be in a cave, but at least you'll have your crypto. It's like digital gold. That's the thesis. So, okay, let's take them at their word. So if that's the thesis, then on days where everybody's worried about inflation, they're worried about the deficit, and NASDAQ is down 300 points, and interest rates are up, crypto should be up. And on days where everybody's feeling great, NVIDIA's up, and NASDAQ is up, and rates are down, and nobody cares about inflation, crypto should be down. And does it act that way? It does not. It acts exactly the opposite of its own thesis. Its correlation to NASDAQ is like 75%. So to me, it's just another way for people to speculate on speculating. So what do I do then? There's no data point of research that says that it's right or that it's wrong.
So at this point, you don't like crypto, debt, whatever.
I never have, but I'm not short it. I don't short it because there's nothing to short.
How do you get an edge at a time where everyone loves AI? And where everyone's scouring for the plays that are best to expose them?
I'll just give you one example of a stock that I think eventually will become a great AI play, which, I mean, the whole thing about getting an edge, I think, is overrated because most people have all the facts. It's a question of how you interpret the facts. I mean, people think that I had some sort of unbelievable edge about the subprime mortgage sector. I had the same facts everybody else had. I just looked at them differently. So, right now everybody's focused on NVIDIA and AMD and data centers, but one day, and that day is not too far from now, there'll be a lot of AI apps that you and I will use. And we're not going to use them at a data center in the cloud. We're going to want to use them on our phone because we want it at the head end, right here. So at that point, there's going to be, I think, an entire new sales cycle of phones, laptops that are going to need to be upgraded to be able to do all this stuff that eventually we will want to do. That's Apple.
So you're buying Apple aggressively?
Well, we've owned it for a long time, and we continue to own it. But it's not actionable at this second because that hasn't been an app. What app? I don't know. When it shows up, I'll let you know. But until then, But at that point, the phone, I have the new phone. That phone is not going to be probably not going to be capable to do some of the apps that you're going to want to do.
It appears that's the direction of travel. I know you've talked about this in the past. I'd love to hear it again. The electricity grid.
Yes.
The demand on electricity in this country, given where policy is, EVs, where AI is going, how great is it going to be? Are we in a position to supply it?
So the utility budget, CapEx budgets go up every single year. They update them. They do like a 3-year forward look, and it comes out, January when they report, and the utility budgets, 3-year budgets are up 20%. It's an enormous sum. They're going to go up even more because the NVIDIA, AMD chips use a lot more electricity than the CPUs do. So there's even more pressure on the grid. So the cycle of, improving the grid, building, green type of utility structures, whether it's wind and solar or just upgrading what you have, is going to go on for a very, very long time. I'll just mention one stock that I've talked about before.
Please do.
What do utilities do? They send you electricity and they send you a bill. But when they actually have to do something, they hire somebody to do it. So when you hear that utility A is increasing its CapEx budget and is building a solar or whatever, or a gas, whatever, 9 times out of 10, they hire a company called Quanta, which is the largest utility-related engineering company in the country. We've owned it for a long time. But what I would say the amusing thing is I'm on the quarterly call every quarter, and every quarter the CEO looks happier. And you think, hey, I couldn't look happier because he was so happy last quarter, but he's even happier today because he has so much business, he can't do it all.
That's the winner. Is there a loser? Is there a short for you, an active short?
I'm not talking about shorts.
No?
I mean, I do a little shorting for myself, but that's it.
Could you think of a theme, though, associated with that, where there could be a group of companies that would lose in that world?
Well, I would say, just as an uber theme about companies that I probably would not invest in, are, the stocks that did really well, call it 2018, 19, 20, 21, were the very high revenue growth, negative earnings companies, kind of like public venture capital companies. Those got destroyed in 2022, down literally 75 to 90%. They've come back, but when you're down 75 to 90% and then you go up 50%, it doesn't look so good on a chart. I would just avoid those companies until it becomes very clear that they actually have real business models where they can actually make money.
In just a moment, we'll catch up with our analyst at Bloomberg Intelligence on the Walt Disney Company. That stock is down by about 5% this morning. Can we squeeze in a question on Marvel?
Yes, we can.
Which you have some expertise.
I do.
This conversation could go a whole lot longer than maybe we needed to.
It could go for hours.
What do you think is the problem with the franchise, please?
I'm going to brag a little bit. I own one of the largest digital comic book collections on planet Earth. It's 11,000 comics on my iPad.
Wow.
And I've read all 11,000. So I could write a dissertation on Doctor Strange that would go for 200 pages.
Bob Iger might read it.
Yes, you probably would. It'd be very interesting.
Maybe they should make it into a movie.
So the problem with Marvel movies, to me, is that they had a great story, and it ended. And Iron Man is dead. Captain America is 90. And Thor, and this really upsets me, and I really am serious about this, they made Thor into a comedic buffoon, and it was always one of my favorite comics. So Thor being a comedic buffoon, I find extremely upsetting.
This is Hemsworth.
Yes, and there's no story anymore. They had a story where they had all these different tangents, but it all wove down into one eventual story, and then it was over. And they have been unable to find a new story. And the problem is that their 3 great characters are gone. So even if they had a story, who would want to go watch?
Steve, this was
I would
great.
just say, with the vinyl, just as an example, the last Guardians of the Galaxy movie was unwatchable.
Steve Eisman with his Walt Disney review. Steve Eisman of Neuberger Berman. Steve, this was great. It's good to see you. Thanks, buddy, as always. The Disney stock is down by 5% this morning for other reasons. Up next, Disney reporting better than expected earnings. We'll get the review and why the stock is lower from Geetha Raghunathan of Bloomberg Intelligence. You're watching Bloomberg Surveillance.
is on the heartbeat of the tech sector.
Spread across global markets.
The real-time data aspect is going to be important.
We're going to bring you expert analysis on that. Sure.
Don't miss Bloomberg's interview with the
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. How has that shaped your strategy for the bank? Is this new normal? Is this like a catalyst? Do you think we're in a new phase for dividend policy overall? That's a great question. I'm Francine Lacqua, and this is The Pulse, every weekday only on Bloomberg.
Good morning. This is Bloomberg Surveillance.
This is Bloomberg Daybreak Europe.
You're watching The China Show.
This is Bloomberg Technology.
This is the countdown to the close.
Welcome to Balance of Power. This is Bloomberg.
Equities just about unchanged on the S&P 500, going absolutely nowhere. It's time now for your morning calls. First up, Citi upgrading Gap to buy, citing strong fourth quarter earnings and full year momentum ahead. The analyst also noting management's conservative guidance. Your second call from TD Cowen, downgrading CVS to hold, highlighting downside risk and uncertainty in the first quarter. The analyst seeing an uncertain 2025 outlook for the drugstore chain. And finally, Wedbush maintaining its outperform rating on Apple ahead of the tech giant's latest iPad unveiling. Wedbush Managing Director Dan Ives saying this: Street focus will be on the drum roll for Apple's AI reveal at WWDC in June. This product cycle will also include new iPads announced today, further speaking to a broader Apple hardware-driven upgrade cycle over the coming year. In a nutshell, we believe the worst is in the rearview mirror for the stock. Meanwhile, Disney reporting better than expected earnings thanks to narrow streaming losses and higher ticket prices at the theme parks. Shares are up 29% year to date before today as the company beat estimates for the fourth straight quarter. Geetha Ranganathan of Bloomberg Intelligence joins us now for more. Geetha, that stock is lower in the pre-market by something like 5%. Can you identify the big why this morning?
Yeah, good morning, John. So I think the reason it's down is because the guidance for the fiscal third quarter seems to be a little weak. So they did raise full year guidance for EPS gains to 25% versus about 20%. So that's definitely positive. But I think what they said about the third quarter is, and I think this is what is really throwing investors off, is that there is going to be absolutely no growth in the theme park segment. And that was after reporting 12% growth in the quarter that they just reported, which is fiscal 2Q. So that kind of brings into question their guidance for full year theme park profits, because they originally said that it was going to grow low double digits. And I think that spooked investors a little bit today.
Geetha, what's the challenge and where's it coming from? Because based on what we've heard from the company directly, no sign the consumers are tapped out. They're able to put up prices. Those price hikes are being absorbed. Where's the challenge coming from?
So I think in your conversation, John, with the CFO this morning, I think what he said was this is really more due to higher costs. They are, remember, Disney is embarking on this huge expansion in its theme park business. They're expanding capacity across all the parks, but more importantly, and especially in the short term, they're adding 3 new cruise ships. And so I think what he pointed to was elevated launch costs for the cruise ships in fiscal 3Q. I'm not sure the market is completely buying that. I think they do think that maybe momentum is slowing a little bit. We'll have to wait and listen to the call, but that's where I think a little bit of that nervousness is creeping in.
How important is the China strategy right now, Geetha?
China's strategy is definitely important for Disney, and this is, we've seen this kind of across the board for all of, the studios. So Disney obviously enjoys a huge presence in China, not just with its films, but obviously also with its theme parks. With the international theme parks, actually, momentum is back, and it's back in a very, very big way. Both in Shanghai as well as in Hong Kong. So we've seen some really good results that has actually contributed to, the profitability in the theme parks, throughout this year so far. But as far as the movie strategy goes, we've seen that China has almost completely shut down Hollywood releases, and that's going to be a big overhang for Disney and across the board for most studios. So the theatrical results, and this is where Disney has struggled a little bit over the past few quarters. They've had a whole string of underwhelming releases. again, I'm not so sure we can bank on a strong China performance for Disney going forward.
The CFO really just wanted to not discuss that and said we make people smile in China, and that's what we're going to continue to do. John tried to get him to bite on what's going on with Hulu. We had JP Morgan come out, Morgan Stanley, in terms of the valuation of Hulu. Where do you see Hulu valuation, Geetha?
So we've actually run some numbers on Hulu. We're actually closer to that 40 billion mark that was put out by Comcast's bank. Again, they're having an independent appraiser kind of run the valuation numbers again. But I think what we have to kind of look at with Hulu is, first of all, they have an extremely profitable and extremely good advertising business. In fact, they were the first pioneers in terms of connected TV advertising with almost $3.5 billion in ad revenue every year. And then you kind of have to think about the bigger picture. Once they integrate Hulu into Disney Plus, we're going to look at a tremendous amount of cost savings, almost to the tune of, $750 million to almost $1 billion. And at the end of the day, it's the Disney bundle that really works. About 35 to 40% of Disney streaming subscribers are on the bundle. So the bundle has value. It curbs churn. So for them, Hulu is really an important part of the strategy. And I think that's where a lot of the value is going to come from.
Geetha, just quickly, does the Marvel catalog have value anymore? Steve Eisman, brutal, just moments ago on that. How much value is left?
I think there is still a lot of value left, and this is exactly what Bob Iger is kind of working on, right? A whole rejiggering of the content pipeline, including Marvel, and we'll get to see that a little bit later this year, as well as next year with the new Captain America movie.
Stock is down by 5%. Captain America is 90 years old, and another movie is coming sometime to a cinema, a movie theater near you, Bramo.
And Iron Man is dead, and Thor is a parody of himself.
A comedic buffoon.
Yeah, so what's the point? That's what he said.
Geetha Raghunathan of Bloomberg Intelligence will tell you what the point is next time we cover Disney with her.
She's not going to do that.
Steve was great, wasn't he?
He was so much fun.
Honestly.
Honestly, actually, my son agrees with him.
I'm not sure how Bob Iger would respond to some of those
We should have him on. Bob, if you're listening, please come. We want to have a fully informed discussion.
Yes, with Steve on the other side of the table.
Oh, that would be so good.
Coming up, Moody's chief economist Mark Zandi on his outlook for a September rate cut. That conversation just around the corner from New York. This is Bloomberg.
Here's the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
60 minutes away from the opening bell, equities just about unchanged on the S&P 500. On the Nasdaq, we're down by 0.2%, 3 days of gains on the S&P, decent 3 days of gains, up by about 3% over that period. Best 3-day gain of the year so far. On the Nasdaq, up something like 4% over that period. I believe we're on a 4-day winning streak on the Russell too. Could become 5, up by 0.25%. Boy, the bond market. Boy, the deficit.
Oh, dear Lord.
Let's talk about it. I love that. I'm going to use that so much. Steve Eisman of Neuberger Berman over about 20 minutes ago saying, oi, the deficit, people are just getting it wrong. So let's talk about the deficit. $58 billion of 3-year notes coming later, $42 billion of 10-year notes coming tomorrow. The day after that, $25 billion of 30-year bonds.
Okay, if you missed it, basically Steve Eisman said people have been saying, oi, the deficit for the past 30, 40 years. I can verify my grandfather was sitting at his table saying, oi, the deficit, back in the day.
Did it rub off?
No, not at all. But here's the thing.
Generational trauma.
Well, it was quite a bit. But here's the question, going forward, is that sort of shifting in terms of, yes, being too early is being wrong in this industry, and yet this has become an unusual time of fiscal expansion where there hasn't been a huge problem in the economy. So if you put that together, people say it's going to start to matter. My big question is, if it doesn't matter, then shouldn't yields be a lot lower?
Only if the economy's doing terribly. Isn't that the argument? Well, the argument for lower yields from here is that the economy rolls over, that the Federal Reserve starts reducing interest rates. Because of that, bonds rally, yields drop.
If you believe that longer term, the economy is going to do well, and that the Fed's going to keep rates at around 3% or 3.5%, that is a new paradigm that I don't think a lot of people have gotten together with, and certainly the Fed has not acknowledged. If that's the case, then you could see a 10-year yield at 4.2, 4.3, 4.5%. But that's my key question longer term. At what point do you start saying, if you take out the fiscal deficit overhang, then you get actually a bigger rally in bond markets that have been a little bit spooked by bond auctions that haven't gone that well?
446 on a US 10-year. Steve Eisman, brilliant. Let's talk about the stock that he was talking about, which was the Walt Disney Company. Disney in the pre-market is down by about 5 full percentage points. His comments on Marvel, I mean, look, when you hear them, he goes through some of the characters, the fact that Iron Man is now dead, and the fact that Captain America is, 90, and the fact that he is very upset with what they've done to Thor, which is his favorite character, which is sort of throwing shade at Mr. Hemsworth, calling him a comedic buffoon. But ultimately, the point stands. How much value is in the Marvel catalogue? Have we seen that exhaustion at the movie theatres? And some people would argue that over the last few years, we have.
To be clear, Disney shares are not down 5.1%.
Not because of Steve.
Steve Eisman is not happy with where Marvel has gone. Just to be very clear for people who are just joining us now, it does raise questions, though on a broader scale, about the number of subscriptions and who they can attract at a time where there is a question about new content, including Marvel. But it is not necessarily his review.
I feel like I'm being regulated. This is what I used to have to do for Tom.
I'm not regulating. I'm just clarifying. Are you saying that it is a significant part of it?
Absolutely not. We're down 5% in the pre-market. Under surveillance this morning, Israeli troops taking control of the Rafah border crossing in Gaza as ceasefire negotiations stall once again. Israel is telling people to evacuate eastern Rafah as it moves forward with its plans to invade. This coming after Israel rejected a ceasefire agreement from Hamas, saying it was, quote, far from Israel's necessary demands. This has gone back and forth now for weeks.
It has gone back and forth, and potentially we'll get an update today because mediators will be meeting once again. Israel did say yesterday when they said that they're not going to accept it, they said they do still seek an agreement and they will be sending representatives to have these discussions. A lot of reporting coming out, though. The New York Times saying that it was only minor word changes, and then Axios with a very interesting report by the fact that saying Israel's very frustrated with how the U.S. is handling these hostage talks. And if that's the case, then why would Israel potentially give in yesterday?
You asked a question, John, to Norman Rule, about the hostages. How many of them are, what is the condition of them?
Don't know.
And one of the reasons why we've heard that there's been some questions around these negotiations is because Hamas cannot deliver 33 hostages that meet the criteria that Israel is asking for alive. And that, I think, is also an undercurrent here when there is not a clear list or understanding of who is still alive and who is not.
Without a doubt, and well said. Let's turn to this story. Apple has reportedly been developing its own chip to run AI tools in data centers. The Wall Street Journal reporting that the effort would build on Apple's previous attempts to make in-house chips. This coming as Apple is set to unveil its latest iPad lineup a little bit later this morning, and then build on that going into June. We all want a sneak peek of what this iPhone might look like come September.
Yeah, and it really is not necessarily the look as much as what it will hold in terms of what kind of artificial intelligence they can really offer. There have been a number of reports about Apple actually creating its own chips. I want to see kind of what technologies they're putting forward on their phones as they try to adapt their own technology in a pretty significant way.
Developers conference gets more interesting, given what Steve was talking about, that ultimately you will see these apps. He doesn't know what they're going to look like, but we know how we're going to use them, which is on a phone, probably an iPhone for a lot of people who can't get away from the thing.
It's going to be a deficit app that's going to be Oi the Deficit. That's going to have a list of the deficit and then some sort of real-time metric about concern being priced in.
I hope that's not the case, but to Steve's point, what he was saying is he just bought the brand new iPhone, and he's saying when all these AI technologies actually start to develop at Apple, he's going to have to upgrade, because the AI capability is going to be actually in the hardware, not just in the app.
I think Apple is hoping that developers come up with something better than the app that
Me
Lisa
too.
just talked
That
about.
sounds doom and gloom.
It depends. For each his own.
A parade of Fed speak continues today. Minneapolis Fed President Kashkari speaking to Bloomberg TV, 1:15 Eastern Time this afternoon with Carol Massa and Romaine Bostic. Do not miss that conversation. This coming after comments from Richmond Fed President Tom Barkin and New York Fed President John Williams, both saying that current monetary policy is restrictive enough to get inflation to the Fed's 2% target. I'm pleased to say that joining us with his view on things is Mark Zandi of Moody's Analytics. Mark, it's been too long, sir. Thanks very much for catching up with us this morning. Why is the concern, in your words, around inflation being above target? Why is that concern misplaced?
Well, I think inflation's at target, appropriately measured, at least underlying inflation. I think if it's very problematic measuring the cost of housing services, particularly owner's equivalent rent. And if you look at harmonized inflation, exclude OER, we're there, and we've been there for quite some time. So, I think the Fed should be focused on the underlying rate of inflation, trying to abstract from the vagaries of the data, the ups and downs and all around. That's why they look at core, excluding food and energy. But at this point in time, I'd also exclude OER. And if you do that, we're there. We've been there for 6-9 months. So to me, it feels like the Fed has achieved its goal, its mandated. We're at full employment, sub 4% unemployment, and we're at target on inflation. And inflation expectations are nailed down to that 2% target. So I think, to me, everything's pointing green for the Fed to start cutting rates here.
Why do you think they don't talk about it in the same way?
I think it's a matter of credibility. I think they said, look, this is our number. We're looking at core consumer expenditure deflator. That's our target. That's the benchmark we're using for underlying inflation. We said we're going to get to 2%, and we're going to get there because they want to ensure that they are credible going forward. I get it. I understand that, and that's why I don't think they're going to move until later in the year, probably around September. That seems like the most logical point where they'd start cutting rates. But they are running a risk by doing so. I mean, it keeps. I do think the federal funds rate target of 5.5% is high, and it's putting a lot of pressure on the banking system, financial system, and broader economy. And they run the risk of breaking something. So they're taking a chance here. But I think at the end of the day, they want to make sure that they did what they said they're going to do. They're going to hit 2% on the core PCE deflator.
Mark, if Tom were here, he would say, let's rip up the script, because I'm getting a lot of hate mail from people who might fall into the Oi the Deficit camp. And we did just have Steve Eisman on. And he basically said all the concern, the gloom and doom about the U.S. deficit is what we've heard for the past 30 or 40 years of Oi the Deficit at everyone's kitchen table. And it won't really matter, doesn't matter for now economically. Do you agree, or do you think that the deficit is actually an economic concern going forward for this government at a time where we could be heading into potentially a less positive growth scenario than what we've had?
Yeah, I think it matters. The deficits and debt matter. I mean, when the reason what happened in the past, we said Oi because all the if we didn't change something, then we would have a problem. But we change something. You know, if you go back and look at previous historical points where the deficit debt were becoming a real issue, like the early mid 1990s would be a good case study. We responded collectively. We came together and we did what was necessary in terms of taxes and in terms of spending to rein it in and you know, put things on a more sustainable path. Here we are today. You know, right now, I don't think deficits and debt matter, but look at the forecasts, and I think the forecasts are, you know, pretty reasonable. Take the Congressional Budget Office forecast, the nonpartisan group that does the budgeting, and if we don't change something, the debt to GDP goes from 100%, and by the way, that's a lot higher than it was 25 years ago. 25 years ago was about half that, so we're at 100% debt to GDP, and all the trend lines look pretty bad. So we should say, oi, we got to change this. And hopefully we come together and change it. But of course, you know, in the fractured political environment that we live in, it just feels like that's going to be a pretty heavy lift.
Which raises the question, at what point it becomes reality? People have worried about it for a long time, but it's not going to be reality until yields actually materially shift higher in a way that's punitive for the U.S. government and that speaks to some of these concerns. Do you see that on the horizon? Do you have a sense of what that rate would be, where it becomes unduly punitive to the U.S. government in terms of interest expenses and where that takes money away from?
Yeah, we're already, it's getting a little uncomfortable, right? I mean, if you look at interest payments, the federal government's interest payments, I think it's over $1 trillion now annually. And that's, I think we just passed the amount we spend on defense. And that's the first time I think that's ever happened, right? I mean, that feels weird. I mean, we're spending more on interest payments on our debt than our own national defense. So I think, you know, pressure is starting to rise. But, you know, here's the thing. I don't think the deficits and debt are a cliff event. It's not like you come up to a cliff and you go over. It's a corrosive on the economy. And as debt levels continue to rise, interest rates will continue to rise. A lot of empirical work trying to understand what the relationship is, but here's a good rule of thumb. For every percentage point increase in the debt to GDP ratio, so you go from 100% debt to GDP to, say, 110%, that adds a basis point. So you go 100 to 110%, that adds 10 basis points to that 10-year Treasury yield. You know, that's not perfectly right, but that's roughly right. And the other thing I'd say is, jargony, it's nonlinear, meaning going from, you know, 100% debt to GDP to 110 is one thing. Going from 150 to 160, that's a totally different thing. So, you know, I don't think, at least for the foreseeable future, we've got a cliff ahead of us, but you know, this is a corrosive on our economy's ability to grow.
Mark, I want to ask you about the labor market because you mentioned how we are running a tight labor market. The Conference Board recently came out and consumers were less concerned actually about inflation. They were concerned about cracks in the labor market. Is it concerning to you when you look through this data? I mean, the last survey, the response rate was 54.9%, lowest since 2002.
You mean the survey rate? Survey you're asking about?
Yeah, do we have the correct read on this data?
Yeah, no, it bothers me. Yeah, and it's getting worse and worse. You know, if you go look at the other I think the JOLT survey, the Job Opening Labor Turnover survey, we're down to like a third of respondents, you know, getting back. So absolutely, and this goes to it's a broader point. You know, all the surveys that we look at and all the polls that we're looking at, they're increasingly less reliable. So yeah, I think this is a big problem, and why alternative data and third-party data sources are becoming more important because, you know, we can't rely on the surveys. They're just much, particularly month to month. And this gets to the, you know, the inflation persistence in the first quarter. Yep. You know, that's just a bunch of, in my view, technical factors, residual effects, and perhaps survey issues, seasonal adjustment issues. So it just, you know, complicates using data the way we have been using data month to month to set, for example, monetary policy.
And Mark, we'd love your view on immigration as well. This has been a big theme over the last few months. And some people, in fact, quite a few guests on this program, basically saying wages have stayed low, even with these really decent, tremendous payrolls figures because of immigration. Mark, do you see it in quite the same way?
I do. I mean, there's, you know, obviously the immigration and what's going on at the southern border is a real challenge for a lot of communities across the country. But the one clear benefit, particularly at this point in time when the labor market is very tight and business has been struggling to find and retain workers, is the surge in immigration. And you know, there is a real clear link between immigration, where those immigrants are going, if you look across industries like leisure and hospitality or retailing, and wage growth in those industries. So I think we can connect those dots, and I think this has been very important. So it allows this immigration allows the economy to grow more quickly, and at the same time take pressure off of inflation. So I think been particularly fortuitous and really important. And You know, if there's one thing we can do to address our long-term fiscal problems, it would be to have a rational immigration policy. Because if we can have more immigrants, and you know, the right kind of immigrants that can really power economic growth, then that's going to solve a lot of problems, including our long-term fiscal problems. And we won't say oi. We won't have to say oi. We've got to cut spending and raise taxes. We got a stronger economy that's generating those tax revenues that we need to finance our government.
I like how that's catching on. Mark, I do just want to finish on this question. It's an important one. If it is important for what's happening in wages in very specific sectors and industries, what happens if border encounters drop, which they have? Based on the information we got yesterday, they've dropped by quite a bit. What happens next?
Well, the labor market's going to tighten up, and it's going to put pressure on wages unless we see continued moderation in demand. And I think we will. You know, I think that will happen here because interest rates are high. That 5.5% funds rate target, I do believe, is restrictive, and it becomes more restrictive over time. I mean, one reason why it hasn't bit really hard so far is that households and businesses did a really good job locking in the previously record low interest rates. But that only works for, you know, a period of time. As more households and businesses face higher interest rates, you know, they're going to start to pull back. So I think the economy will slow, and, you know, even with less immigration, I think the Fed will be in a position to cut interest rates here very soon.
Mark, this was interesting. Always good to hear from you. Mark Zandi there of Moody's Analytics. Oi is catching on. You notice that?
Good.
Oi.
Yeah. We don't have to say oi anymore, according to him. Mark Zandi.
Let's get you an update on stories elsewhere this morning. Here's your Bloomberg Brief with Danny Berger. Hey, Danny.
My 98-year-old grandmother, Jewish grandmother, would be so proud of you both. Okay, BP has maintained the pace of its share buybacks, even though profit and cash flow fell more than expected. The CEO said we're highly undervalued if we compare ourselves to our American peers. As long as that kind of gap exists, we should continue to buy back shares. BP is the last oil major to report, and it's been mixed. Shell, Total, and Chevron performed better than expected, but Exxon fell short. Now, Instacart is partnering with Uber on restaurant deliveries. It's going to make a bigger force of competition against the top delivery app, which is DoorDash. Instacart users in the U.S. will be able to order from hundreds of thousands of restaurants on an Uber interface. In an exclusive interview, the Uber CEO told Emily Chang that this is an opportunity for both companies.
Certainly, Instacart is a very strong competitor as it relates to grocery. But for us, it was an opportunity to expand essentially the Uber Eats business, especially into the suburban markets where Instacart is particularly strong.
Bloomberg estimates that DoorDash owns about 67% of the food delivery market. Apple is developing a homegrown chip to run AI tools in data centers, that according to the Wall Street Journal. It builds on the previous efforts to make in-house chips which run its devices, according to the journal, which cited unidentified people familiar with the matter. The code name internally for the project is AC/DC, for Apple chips in data centers. Later today, Apple is going to be hosting another major upgrade to its iPads. That's your Bloomberg Brief. John.
Danny, thank you. Appreciate it this morning. Up next on the program, another setback for Boeing.
In a rush to address its bottlenecks in production, Boeing hit problems, pushing pieces together with excessive force. Effectively, they are putting out defective airplanes.
That company has a problem. There's some of the allegations, the response from the company, the view going forward. We'll summarize that next.
You're a famous photographer, you're a conservationist, you're an activist. How would you define yourself?
I think I'm just a human trying to figure out how to be a better steward of our little planet. I am a biochemical engineer by training. I studied marine biology, fisheries, aquaculture, and then I realized that the ocean is very much out of sight and it needs help. And so I became a photographer to be able to communicate with a larger audience. And thank goodness I was good at it.
When did you realize that actually photography was your passion and you could make a real difference to our world?
You know, I didn't start out as being a photographer, so it was not until 1990-something, 96, when I picked up a camera, and I became a professional photographer soon after. And it's one of those things that it's like learning another language. You learn a few words, and then you put a few sentences together, and one day, you might be able to write poetry.
This is Bloomberg.
Minutes away from the opening bell, equity futures on the S&P 500 just about positive by 0.1%. Yields are lower once again for a fifth session. We're down 3 basis points, 4.45.49. That is quite a turnaround. Under surveillance this morning, another setback for Boeing.
All the problems that we've had, we put Band-Aid over Band-Aid to resolve the problems, and Band-Aid over Band-Aid doesn't cover it. In a rush to address its bottlenecks in production, Boeing hit problems, pushing pieces together with excessive force. Effectively, they are putting out defective airplanes.
The allegations keep piling up. Here's the latest. Boeing facing yet another FAA investigation, now involving its 787 Dreamliner. The troubled plane maker saying it had alerted authorities of potentially incomplete inspections of some of its jets, as well as suspicion of falsified records at a South Carolina factory. Sheila Kaholu of Jefferies joins us now for more, with that stock down by about 0.75%. Sheila, we often have to go through investigation after investigation. Here's another one. How serious is this?
We don't know how serious it is yet. It's on the 787. Boeing did self-report it to the FAA, which is a positive step. It's a very heavy physical task that the Boeing workforce performs in Charleston on the 787 with a low failure rate. But we don't know when they stop performing it and how much rework is involved. So we'll see how much of a hit it is. Spirit's reporting it's a $50 million loss for them in the second quarter because of this work, because Boeing's going to have to slow production on the 787 because of this. Boeing's also slowing production on the 787 because of heat exchangers using titanium from Russia, as well as some interior supplier delays. So we've seen now 3 issues pile up on the 787, and that's really what made us cut our delivery forecast from 90 to 60 units for the year. But, you know, this is a problem inside the Boeing factory. Charleston's actually a beautiful place to live, a beautiful factory. There's nothing that could be very nefarious in that site. So I think the new CEO has to come in and ask the workforce what it needs to perform tasks accurately, whether it's wages.
Okay, I'm sorry. Pause. Why are we not just doing some big whole-scale investigation, internal investigation? Why are they not hiring an outside firm to come in and basically do an unbiased, complete sweep of what could go wrong so that they can figure out how to change things?
There's been a host of committees after committee, you know, a safety committee, this leadership, that leadership. I think what we need to do is see what the workforce needs. You know, one of the things we've talked about is the workforce hasn't had a pay raise since 2014. 30% of the workforce, which is part of the IAM union, is set to negotiate in September or in the summertime with a September deadline. So we'll see if that brings any improvements in terms of the workforce getting a raise. We've seen a 30 to 40% raises across the airlines. So we could see something of a similar magnitude at Boeing. But also I think some of these processes need to be fixed. Maybe working with the FAA and saying this test doesn't make sense. It takes us very long. It's very physically arduous to perform. So can we remove it given it doesn't have a failure associated with it? So maybe some sort of more, I think rather than a law firm coming in or an audit committee coming in or a safety committee, it's just speaking to employees and seeing how tasks could be performed differently.
I go back to an earlier FAA report that talked about this disconnect from the shop floor, those workers, to the C-suite. Who's running that now? Who's trying to understand what is going on the shop floor and why that information doesn't seem to trickle up to management?
Boeing have a COO in place. So, you know, there are layers of management. I just think perhaps an overhaul of the system and how better manufacturing processes could be put in place. And we've seen that done. I go back time and time again to General Electric, where facilities used to be run differently. And with new management, Larry Culp has come in and changed the facility layouts to better perform for workers in the factory. So I think it's maybe a little bit of an overhaul. And that's why Spirit, I'm going to bring Spirit up today because they just reported a massive loss this morning. That's why Boeing's looking to double down and buy Spirit. Not because I think that it could be easier to buy Spirit, but because Spirit will need that cash infusion, whether it's automation, a new facility, a facility overhaul, to perform better.
When automakers get into trouble, I'm thinking more recently of the Takata airbag scandal, if we can call it that. When you had to recall tens of millions of vehicles, kind of got an idea of how that works. How does a mass recall of airplanes, what does that look like? if they had to do one?
We've seen them actually since 2020. We've seen it whether it's with the MAX or the 787. Let's not forget that 787 didn't deliver a single airplane for 2 years. It just restarted deliveries about 18 months ago. So it's had a whole host of issues, but it's producing at a lower volume, right? We're at 5 a month. The 737, it's supposed to be at 38 a month, but we're really at 15 to 20 a month. So 787, and the facility is brand new in Charleston. And so it's a much cleaner, leaner facility to work at as well.
Sheila, this was awesome, as always. Sheila Coley there of Jefferies, as the allegations and investigations, Lisa, keep piling up over at Boeing.
I thought what Sheila said about wages was interesting. Basically, if you have people who had to go into the office or had to go into the plant during the pandemic, who got no raises, and they had to do all of these extra things that took a lot more work, well, why not cut some corners because no one's paying them anyway? How much is this really basically a quiet quitting issue, or sort of how do you get people enthusiastic again?
As some people suspect, based on yesterday, some corners have been cut. In fact, many corners. Equities right now on the S&P 500, positive here by 0.1%. The opening bell is about 34 minutes away. Coming up tomorrow, here's the lineup for you. Marvin Lowe of State Street, Christian Mamani of Lafayette College. We'll catch up with Mandy Zhu of SIBO, and we'll speak to Kathy Jones of Charles Schwab as this bond market, Lisa, keeps on rallying.
Because people believe in the disinflation narrative. You hear Mark Zandi, he's saying this just finally gives us the excuse that we all are seeing, which is that inflation's coming down and the Fed will be able to cut.
He's not screaming, oi, the deficit.
Well, he actually says we should say oi, the deficit a little bit.
Just every now and again.
Yeah, because
it's not too much.
The oi is actually what makes it not a problem, because then people deal with it.
3 hours of sophisticated high-end conversations on this program, and this is the takeaway.
100%.
Oi, the deficit. Okay.
And Marvel.
From New York City, this was Bloomberg Surveillance.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
What's it like moving from the East Coast, where everything is finance and money, to the West Coast, where everything is technology? Did you fit in right away? And did you really know how to use all the computer things that they give you to use?
So it was pretty fun. There were plenty of times where I would sit around in meetings and literally I would be Googling terms. And at one meeting, Larry Page actually caught me Googling terms, and he kind of pointed that out to other people in the room, which was a little embarrassing, but I figured there were some things that I could do that they couldn't do. And so it was a learning curve. And my dad always, he taught me at a young age a term that I've used constantly with my teams. He said, in his lab at Stanford, if a physicist could not define a quark in under 30 seconds, they didn't know what they were talking about. And so I use the quark test all the time. If somebody's rambling on and they can't get to the point, they probably don't know what they're talking about. They fail the quark test. My finance team knows this quark test. And at Google, I'm working with amazing computer scientists, so they never fail the quark test. They can explain things really clearly, which shoots you up the learning curve.
But did you understand what they were talking about from the beginning, or did you have a special tutor that's taught you technology? Or did you
I had actually run tech banking and took Google Public, so I had a little sneak preview.
The names that move markets are on Bloomberg.
How worried are you about the U.S. election? It's for the American people to decide what they want with their politics, with their government, with their future. But obviously, we are all concerned about it because the United States is the largest economy, the largest defense country in the world, and has been a beacon of democracy with all its upside and downside. We cannot interfere with their choice. It's their choice, and that's the beauty of democracy. But we have to be extremely attentive and anticipate, just as we do with inflation. You know, we do scenarios. What if, what if, what if? Then what do we do? Where I sit now in Frankfurt, head of the ECB, I think that we have to be strong as Europeans and not assume that we can rely on whoever our friends are around the world, because these things change over the course of time, as we have seen.
Bloomberg. Context changes everything.
From New York City, from viewers worldwide, a very good morning. I'm Manus Granny. So we're pausing for thought. We've got Kashkari later on in terms of the Fed speak, but it's not exactly a whole new world at Disney. The stock is lower. Bob Iger has a challenge to do. Subscribe more. Countdown to the open kicks in right now. Coming up on the show, those futures, they lack conviction after a strong start to the week. Traders brace for more Fed speak with limited data on the docket. And shares, as I said, in Disney under pressure. The subscriptions miss the mark. We begin with the big issue, growing rate optimism.
As the data come in, hopefully we'll be moving in the direction we want to see, both on inflation and in terms of restoring balance to the economy, and then we'll make our decisions based on that.
If they haven't cut in September, they're likely to cut in December. Again, there's still a question of will inflation actually decelerate enough by then?
It is going to come down to that disinflation narrative. Mike McKee is with me. Mike, what did we learn yesterday and what are we set for today? We've got big auctions, but a mountain of Fed speak to get through before the end of the week.
Well, the auctions might end up being more important because they're today. There is a question about how much there's going to be take-up of the Treasury debt and at what price. But we do have a lot of Fed speak that probably isn't going to add much to the discussion because, as you heard, people have already made up their minds on the Open Market Committee that they're going to wait for a while. Here's what Tom Barkin from the Richmond Fed said yesterday. He's optimistic today's restrictive level of rates can take the edge off demand in order to bring inflation back to our target. The full impact of higher rates is yet to come. Now, that kind of explains where the Fed is at and why the markets don't necessarily like it. Take a look at this chart here. The Fed is looking at real rates. And as you can see, real rates are at levels that led to recessions in the past. The market is looking at the blue line below, which is financial conditions, which have loosened. And they think the Fed might be setting us up for additional inflation. So who's right? Well, there's going to be a lot of data between now and the June 12th Fed meeting, and that inflation data is going to be very key. So while we may not get something new out of the Fed speakers this week, we do have CPI next week. The Fed minutes, did anybody at the last meeting talk about raising rates? And then another PCI, another CPI before the Fed meeting. So they'll have plenty of data to look at and see if they have that confidence they're looking for to lower rates.
Well, that conversation on raising rates was something that Powell really did push back against. Mike, thank you very much. Mike McKee. Today, we have an interview. We will bring that to you with the Minneapolis Fed President, Neil Kashkari. That's coming from the Milken Conference at 1 p.m. on Bloomberg TV and radio. Let's continue the conversation. Quincy Crosby of LPL Financial and Ed Al-Husseini join me from Columbia Threadneedle. Gentlemen, good to see you both. 5 days that shifted the dial on 10-year, 2-year, and 5-year paper. This is the 10-year government bond yield, down by 23 basis points in the space of 5 days. The bond market's faith in rate cuts has been restored. Has yours? Ed, good morning.
Hey, good morning. No, I think you're absolutely right. I think it was really a function of the Fed reminding us that the threshold for rate hikes remains relatively high. And that's something that was kind of seeping back into the market given the inflation data in Q1. And the Fed's effectively taken that off the table. That's been a really nice temporary ceiling, I think, on the longer part of the curve.
Okay, so that's a nice portion. Quincy, good morning to you. Here we are. You know, the equity market has taken flight. A number of reasons. You have earnings, but you have this repricing at the very short end of the curve and the faith in cuts, perhaps not fully restored, but reignited. What does it mean for you?
Well, one of the other aspects for the market is the liquidity that the Fed offered with the quantitative tightening program. That certainly helps the market, and it helps the market for a number of months, probably going through to the election. But overall, the earnings have come in better than expected. Obviously, the market is now waiting for the 22nd when we hear from NVIDIA. But overall, this is a market that needs something. If we're not going to have rate cuts, you've got to substitute something else. And that has to be an economic backdrop that is not hot, that's not cold, but just looking at a rebalancing of this economy and a cooling of the data. But overall, we have seen the market with the S&P 500 regaining its 50-day moving average. But one thing we have not seen is on the days that the market has been up, closing higher, the volume hasn't been there. It tells you that the market needs more confirmation for an endurable rally. If this rally can continue, it is going to probably lead us with a strong market through the summer because the historical patterns indicate that. So I think absolutely that where we land with the 10-year Treasury, where we land with the 30-year, with these auctions, it is going to be, we hope, a catalyst for this market to say, okay, this is what the auctions are telling us. Let us move ahead and offer more confirmation to the equity side of the market.
So, Ed, it's up to you and your tribe to deliver. 6-month T-bills were welcomed over 3 months as that rate cut narrative got wound up. We've got 42 billion in 10s. We've got 25 billion in 30s coming a little bit later. Now, as Quincy says, it's over to you. Prove to us that you can eat a bountiful meal and not get any indigestion. Is that how you see the 125 billion that we will have had by the close of business this week?
Yeah, look, I think demand for duration assets, long duration assets, whether they're coming from the Treasury side of the house or high quality investment grade debt, has been really well met this year. I don't really see significant issues in us being able to digest this supply. You know, on the margin, the Fed's balance sheet is in the background. It provides a little bit of background music. I don't think it's all that important for taking down these auctions. I think the key issue here is the all-in yield, whether you're looking at the long end of the Treasury curve or, again, you're looking at it through a credit lens, the all-in yield is very attractive. And there's plenty of institutional investors who are still coming off the sidelines into this market. So I'm not really concerned at this stage that we'll see any kind of dislocations in these auctions.
So, Quincy, back to your point, which is, you know, you need to see some kind of, as it were, confirmation of this Goldilocks-like scenario. I was looking at what Morgan Stanley have had to say, and Ed, you can chew on this, which is buy bonds because there will be a rapid deceleration in PCE without the economy tanking. So to your point, Quincy, this is really what we need to see. We need to see reasonable growth with reasonable profit margins and a dissipation in inflation. Is that enough to put a floor in equities and maybe even propel it higher?
Well, yeah, I mean, one of the things we're seeing from this earnings season is that profit margins have been strong. We always look for that because that is the key to whether or not they are going to have to turn around. These companies are going to have to turn around and let people go. You know, the labor market, yes, it is holding up. It's solid. But there are questions as to how long this can continue, because after all, that is the pathway towards a recession if the consumer feels that there are no jobs and they start seeing major layoffs. So we go back to the earnings and we hear operating margins, okay, profit margins, okay. That is excellent for the tone of the equity market. What we want to see, though, is that the yields are not coming down so quickly because they are looking at a much weaker economy. You know, when we look at utilities, utilities have very often been that guide that when rates are higher and utilities do well, it is the utilities market suggesting, we're reaching a top. We're going to start seeing the rates come down. But there's another element now for utilities. Is it also suggesting that, you know, we're going to need to upgrade our grids? We're going to need more power for the data centers. So that's also entering into the conversation about what utilities typically tell us. But overall, what this market doesn't want is a escalator down or an elevator down quickly with those yields.
So Ed, with that in mind, just listening to what Quincy's saying is we don't want an escalator down in terms of what's going to cause yields to drop. And this goes back to what Morgan Stanley are saying. They said it is residual seasonality that will impact the slow drift lower in PC, not the escalator down that Quincy is outlining that we don't want. Which one do you expect is the firmer narrative?
Yeah, look, I think there's a really good probability that inflation, the decline in inflation was a little bit exaggerated into the end of last year. It was perhaps a little bit exaggerated to the upside in Q1. And, you know, underlying inflation is running at about 3%. We're likely to see some cooling off of those levels. The thing that I'll point out is if you look at where rates and risk markets are today, they've priced in very healthy growth, close to 2.5% consensus. They've priced in relatively lax financial conditions, and they've priced in a little bit of room for the Fed to cut, you know, roughly 40 basis points. Let's call it 2 cuts this year. That's consistent with some of that inflation coming down. So that Goldilocks scenario is very much already in the price. And I think what worries me is with expectations being nailed to the ceiling, particularly around growth this year, it's going to get a lot easier to disappoint them to the downside. And I think we're starting to see early signs of that in the labor market. We're starting to see early signs of that in the growth story.
Well, we certainly saw some cracks in the services industry. We've seen trading down, perhaps, at some of the broader retailers. Quincy, let me get your perspective. Disney has been sort of a couple of different stories this morning, but if I look at Disney, it is about subscriber growth disappointing relative to what the market wanted. The CEO's on the tape now talking about password sharing, cracking down on that. The stock is down by 8%, but when I look at the business, parks growth is moderating from peak COVID levels. It's more about a normalization on the consumer side of the business in of itself. What did it say to you? What does Disney say to you about the health of the consumer?
Well, yeah, no, I was watching that very closely, but you still see the growth in terms of the parks. It was over in Asia. It was in Asia, over in California, it was much slower. When we look at Florida, we know that the numbers are coming down. It's too expensive for the average American to even go with just, one child. And this is a tell, not just from Disney, but it's a tell across the consumer-led economy, that at what point do consumers, not just the low end of the wage scale, but mid-wage earners, start to pull back and say, I've really got to pull back. So far, that isn't the case. Americans are spending. They are going on vacation. They're booking tickets on planes. The Amex, which looks at business spending very much, says things look good. From the other credit cards, they say, you know what? Americans continue to spend. The Fed, if you listen to Powell, he talks about that low wage earner and concern about that particular cohort. And that suggests that this Fed still wants to be able to cut rates, perhaps even with stronger inflation. When we looked at the ISM, Institute for Supply Management, the service sector, it pulled back into contraction territory. Mm-hmm. But just like with the manufacturing, the prices paid up. That is inflationary, and you can't dismiss it. We need to see those numbers come down for the Fed to feel secure in saying, okay, maybe now we can cut rates. Maybe September, maybe too soon. It'll look as if we're political. Maybe December. But you can't have them cut rates when those prices are climbing higher in the backdrop of weaker growth. I hate to tell you, everyone knows what that means if it continues. It is not a healthy backdrop for this economy or for the markets.
No, but then it almost feels as if it's the slow cut of 1,000 cuts, isn't it? A little bit of ISM slowing down, a little bit of consumer slowing down at Starbucks, a little bit of consumer slowing down at other retailers. Ed, to what extent are you and the bond team buying into the hypothesis or believe in the hypothesis that immigration, as Adam Posen said to me, if you're not a border politician, immigration is good. It contains the wages spiral. Is that part of the alpha for bonds going forward?
I mean, immigration's been a really interesting story. It's definitely played a big role in adding to the supply side of the labor market. The extent to which it's impacted wages is probably relatively small in my mind. You know, last year we were talking about 3.5 million people missing as a result of, you know, lower participation post-COVID and missing migrants. Now perhaps we're about 2 million people above trend. So there's been a swing of about 5 million workers. Our labor force is 160 million people. So the extent to which that 5 million makes an impact on wages is not huge, but it's important. It's good towards balancing out the number of vacancies and so on that we have in the labor market, and it reduces the churn in the labor market, which is something the Fed's been looking for. Does it impact wages? I would say not really.
Okay. Well, maybe it is that we need to redefine what scale of immigration, what type of immigration contains wages in various component parts of the economy, rather than that sort of umbrella statement about immigration. Ed, thank you very much. Quincy Crosby and Ed Al-Husseini on the markets this morning. Let's look under the hood. Ahead of the opening bell, Abigail Doolittle is with me. Abby, what have we got?
Well, despite the fact that we do have the U.S. equity futures slightly higher, we have a couple of notable laggards to take a look at, including Disney. Shares heading to the worst day in about a year, down 7.5% for the reasons that you all were just talking about. Streaming subscribers coming in short of the estimate, a lagging growth in parks ahead. They did raise the revenue guide, but it was slightly short of the street. And into today, up 29% over the last year, so investors wanted more. Palantir down 12.4%. The data company boosted its forecast, but not enough for a stock, if you can believe it, up 226% over the last year into today. Price to perfection, you could say. But take a look at Peloton, up 20%. CNBC reporting that a number of private equity firms are circling, considering buying the fitness company Manus.
Okay, Abby, thank you very much. Keeping an eye on those stocks as they move. Coming up, Disney beats profit estimates.
We're obviously very judicious with the way that we price. We want to provide access to as many guests as we possibly can. But we do believe that the great experiences we provide, people are willing to pay for.
Strong earnings report overshadowed by that miss at Disney Plus on the subscriber side. All in conversation next on Bloomberg.
Names in tech are on Bloomberg.
There's a natural tension between the need of a supplier to scale and the need of the customer, the car maker, to differentiate, try to make something that is unique.
We have a long-term partnership with Tesla, and it's still strong, but Tesla is not the only partner that we're seeking, and we want to diversify and really make the EV market in general stronger and sustainable.
All these devices becoming smart devices. They all need a brain inside that helps them learn what to do. That brain inside is ARM.
I'm believing the next user experience is going to be based on Gen AI on the phones. We're optimistic that we could start to see devices as early as this year.
Our job is to provide great index products and then to be the listing exchange for those index products that allow investors to invest in all sorts of tradable instruments, including now Bitcoin.
Nobody covers technology like Bloomberg. Context changes everything.
This is Bloomberg.
We took prices up a little bit in the beginning of this year and didn't really see much of an impact. So as to what the future brings, we're obviously very judicious with the way that we price. We want to provide access to as many guests as we possibly can. But we do believe that the great experiences we provide, people are willing to pay for it.
Well, Disney stock is slumping pre-market despite beating on profit estimates and raising the guidance. What spooked the investors is this: fewer subscribers to the Disney Plus streaming service than was expected. Geetha Raghunathan is with me now from Bloomberg Intelligence. I mean, this stock has been everywhere this morning. We're down over 8%. They're talking about cracking down now on the password sharing, so very reflective of what Netflix did, Geetha. Why such a virulent reaction to the miss on subscribers?
Yes, so I think it might be partly subscribers, Manus, but I think the bigger reaction is really caused from the commentary on the parks business. Remember, parks is the main anchor of the whole Disney company. It brings in about 2/3, almost 60 to 65% of total company profits. And basically what they guided to was not only a little bit of a weaker outlook for the next quarter, which is fiscal third quarter, but also they spoke about a moderation in demand. And when you see a moderation in demand, then that really kind of worries investors, because then there are questions about pricing power and whether the business can really kind of sustain momentum going forward.
Yeah, and therein lies the point, isn't it? It's about how expensive. Our last guest was talking about the expense, the cost of actually going to a park in America relative to perhaps some of the others. The stock is down 8% pre-market. Geetha, thank you very much. Another stock that we're keeping an eye on this morning is Boeing. Now, the plane maker is facing yet another investigation from the U.S. Federal Aviation Administration. This time it involves the flagship 787 Dreamliner model. Sid Phillip is with me now. So Sid, this is to do with, again, attention to detail in the checking process on the plane between the wing and the body. Talk me through what is exactly challenging them again today.
Morning, Manus. So yes, Boeing is in the throes of yet another investigation, this time over their 787 wide-body model, which is their advanced model and their flagship, essentially. And what a whistleblower at Boeing alleged was that shortcuts were taken and crucial tests that were meant to check the attachment of the wing to the body of the aircraft, they weren't conducted, and essentially they alleged that they were essentially overlooked, and they fraudulently signed off documentation, said those tests were completed. And that's really added another sort of layer of complexity to Boeing's already growing sort of regulatory scrutiny, and that's just going to add more pressure to the company at the moment.
We also caught up with Sheikh Ahmed bin Zayed Al Maktoum. He is the chairman of Emirates. He said, the delay that we see, I don't think that we're happy. So again, you've got Michael O'Leary being supportive to Boeing. You've got Sheikh Ahmed, again, trying to be supportive to Boeing. Is there some kind of an inflection point here? The fact that Boeing came forward with this information, should the market, is that what the market is taking some substance from?
At the moment, there's a lot of unknowns really in terms of what the impact of this is. I mean, they haven't really said how many aircraft are affected. Boeing's talked about how the FAA said there's no immediate danger to the in-service fleet in terms of requirements for grounding or any of that. But at the same time, it's going to be crucial to see how many aircraft are impacted. And the FAA has asked Boeing to come up with a plan for the inspection of the in-service fleet. It can also impact deliveries of the 787, which is a crucial source of cash for Boeing. So that's really the key in terms of what the impact is going to be, and that's really going to have an impact on share prices as we go forward.
Okay, well, certainly the message from Emirates is that the management promised that they will change things and make things go faster. To coin a phrase, I hope so, from Sheikh Ahmed. Sid, thank you very much. Sid Phillip at tracking the Boeing story. Coming up, your morning calls. A little bit later, we've got B of A's Wamsi Mohan joining me with his outlook for Apple. And that's after he named it as his top pick in the earnings season. Early, prescient, and on the money on Bloomberg.
From the beating heart of global finance, economics and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. How has that shaped your strategy for the bank? Is this new normal? Is this like a catalyst? Do you think we're in a new phase for dividend policy overall? That's a great question. I'm Francine Lacqua, and this is The Pulse, every weekday only on Bloomberg.
Let's get you some of your morning calls from the analysts on Wall Street. First up, TD Cowen downgrades CVS to a hold, citing further downside risk and uncertainty after Q1 results. Bank of America adds Nike to its US One watch list, naming it as their best investment idea for the year ahead. And finally, Citigroup upgrades Target to a buy, pointing to strengthening margins and improving inventories. Coming up on the show, he is the analyst that called Apple his top pick. That was ahead of the earnings. Bank of America's Wamsi Mohan joins me. We preview the Giants' big event on Bloomberg.
Arch has laid plenty of groundwork for future revenue, but for now, Mark Messler's most pressing challenge as CFO is conserving capital.
You have to have the short-term discipline to sort of circle the wagons around cash. I mean, cash is oxygen. I know where every ounce of cash is going, and but we also have to be nimble around that as well because things change by the day.
Archer went public in 2021 in a reverse merger with a SPAC, Ken Moelis's Atlas Crest Investments. Through August 2023, the company raised over $1 billion from investors, including Stellantis, Boeing, United Airlines, and Cathie Wood's ARK Investment Management.
Does that ARK investment open doors for you to bring in different kinds of institutional money going forward?
It does. I mean, I think there's a lot of credibility that comes in with an investor like ARK. As I think about, my top targeted list of investors over the next 2 to 3 years, an investment like that gives us some credibility and gives us a little bit of staying power as I go in and talk to other investors.
With the SPAC pipe now closed, Archer's facing a new phase of raising capital.
I know the folks who aren't willing to invest right now may have large pockets of investment in the future. So I want to be in front of them. I'm wanting to show them progress. I want to create credibility with them that we are marching towards our goals of commercialization.
In a multi-trillion-dollar industry, there's a lot of ground to cover.
Bitcoin ETFs rubbing elbows with the big dogs.
This frenzy has engulfed the entire world.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, only on Bloomberg. Get your fixed income fix. Watch Bloomberg Real Yield every Friday right here on Bloomberg. Context changes everything.
competitive bid in these stocks. We're really trying to sort of find our footing. I don't know whether we can bloom for as long and last as long as flowers.com, but right now this market is up. We're going to get a little bit more Fed speak later on in the day. Yields are lower, and that is what's driving the breadth story today, up by 0.2% on the Russell 2000. This is how the rest of the market looks. You've got the euro dollar trading a little bit higher. The German factory orders actually were a little bit lighter on their feet. Demand falls in February, so that's from February, I should say. So those numbers a little bit lighter in Europe. 10-year yields down 4 basis points today. I can tell you in the past 5 days, there has been a continual momentum down in yield on the bond market, down by over 20 basis points at one juncture. Crude is down by 0.25%. So that's the state of play across the assets. One stock to watch, we've touched on it a few times, it is Disney. The shares are under pressure, posting fewer than estimated subscribers on the Disney Plus streaming service. We've already had a conversation, Abby, haven't we, where it seems to be about the parks business also under pressure.
Yeah, that's exactly it, because that parks business really the reliable cash cow, and now there's some concern that growth for the current quarter, because it's basically flat, investors concerned, worried that maybe there's going to be some sort of an issue there. Relative to the stock, you can see that it's really plunging down 8.5%. Its worst day since last year. At the lows, though, this morning, just moments ago, down 9.3%, the worst day since November of 2022. So investors really concerned again, despite the fact that they did beat profits, there was a small revenue miss. When you put it all together, they raised the fiscal year profit view from 20% growth to 25% growth. The street looking for 25.5%, so a small miss there. To your point again on parks, the growth is expected to moderate. The small subscriber miss for a stock that was up 29% this year into this report, over the last 3 days into the earnings report, Manus up 5%, really suggesting that investors were looking for just a clean quarter and guide across the board. They didn't receive that. This stock now again down 8% on the morning.
Yeah, pretty brutal. Abby, thank you very much. Let's turn our attention to the software market. Palantir falling after investors were unimpressed, to say the least, by the company's outlook for its annual sales. The stock has tripled this year into the numbers. That's some context for us, Alex, isn't it?
It is, Manus. Well, unimpressed is definitely an understatement when it comes to this report. The company actually did deliver on earnings, but it didn't deliver on guidance. That likely explains the downswing that we're seeing this morning. Shares down about 11%. That's the worst since November 2022. And the company, co-founded by Peter Thiel, is one of the emblems of the AI frenzy that's helped shares surge more than 200% in the past 12 months and about 15% in the 4 trading sessions leading up to the results. But investors were unimpressed by the outlook for annual sales. It nudged up its annual revenue forecast slightly higher to a range of $2.68 billion to $2.69 billion. That is roughly in line with Wall Street forecasts. This reaction, Manus, is a testament to how high the stakes are for companies to deliver on their AI promises. And it's not just about what companies have shown so far, but what they see for the future. And it's really been a theme this quarter. More than 80% of companies have beat earnings this quarter, but we're getting the worst same-day earnings reaction since the end of 2020, and that is attributed to these disappointing outlooks. William Blair says that Palantir is down because of the sharp deceleration in U.S. commercial revenue growth. That's a focus for investors because of the AI push, Manus.
Okay, well, certainly a double-digit loss on the ticker at the moment. Alex, thank you very much. Turn over to EVs. Now, Lucid revealing wider than expected losses to the start of the year. This is as the company contends with production challenges and an uneven roadmap for demand. Katie, just put the two together. This is a bit of a slap down by over 9% at the open.
Yeah, and you really are seeing that pain reflected in the shares, like you said. Let's get into some of the numbers here, because Lucid, it posted an adjusted loss of about 30 cents per share in the first quarter. Analysts had been expecting a loss of 25 cents a share, so clearly a bigger loss than expected. Revenue of about 173 million. That was above expectations. Clearly, that is not the focus this morning. And like you said, Lucid really trying to overcome production hurdles and at the same time sagging consumer demand for EVs. It recently secured about a $1 billion cash injection from a Saudi investor. So maybe that will continue to or start to bear fruit, because Lucid said that it still expects to make about 9,000 vehicles this year. That is reaffirming their earlier forecast. But you take a look at what Bloomberg Intelligence has to say, and their view is that Lucid's Air sedan could, quote, keep dragging on profits, while production increases planned for this year could hurt margins in the second half. You add it all together, shares down about 8% almost at the moment, lower by about 33% in 2024. Just to give you some context, Manis, that is even more than Tesla's year-to-date loss.
Okay, Katie, thank you very much. Katie Greifeld there. Turning to tech. Apple has been developing a homegrown chip to run AI tools in the data centers. That's according to the Wall Street Journal. Alex Webb is with me now. I mean, they're all trying to come up with a solution where they may not be so inextricably linked to NVIDIA. I'm talking about a lot of these players in the Mag 7. But talk me through what Apple are doing and whether it will come to fruition according to the story.
Yeah, so the Wall Street Journal is reporting that they are working on this product. We don't yet quite know what stage of development it is, whether it actually will ultimately be produced, but it is something, these chips geared towards AI, presumably accelerators. Every big tech company is working on them right now. And Microsoft, Google, Meta, and Amazon even. Now, part of that one suspects is that, yes, it will help them build chipsets that are finely tuned to their needs, their precise needs, what they want to do. But also, NVIDIA right now, which is really the only game in town, has a huge amount of pricing power. What we've seen over the past 12 months with the huge acceleration in NVIDIA shares is not just that they're selling more chips, but they are selling the chips they can for more money. And so if you are an Apple, you're probably going to be looking for a little bit of pricing power.
Okay, Alex, thank you very much. Tracking the Apple chip story. Our next guest, pretty much ahead of the pack, making Apple his top pick. That was late April, and he wrote this, that the company has a rich capitalist path with defensive cash flows, to say the least. Wamsi Mohan joins me now, senior IT hardware analyst over at BofA Securities. Your price target is $230. What goes through my mind as they announced the biggest buyback in the history of American equity? Are they on defense or offense on the payouts and buybacks? Wamsi, good morning.
Good morning. Thanks for having me. Yeah, I think this is sort of par for the course is the way I would phrase it, right? Like, if you think about what Apple has been doing, they've been very consistent and opportunistic in their buybacks. Over time, their buyback program has been extremely successful. And it helps, of course, as the stock is up to the right. But when you look at sort of the magnitude of what we're talking about, the $110 billion, right, and Wall Street was largely expecting, we were expecting $90 billion, it just shows the confidence in the cash flows. And this is what we meant by saying there is a defensive moat around the story in terms of continued earnings power and continued cash generation, such that they can keep this level and pace of buybacks, which are, just astounding, ongoing. And that confidence in cash flows is really coming because they do have this potential to really tap into a lot of markets that are not on people's horizons today, right? When you think about healthcare market, for instance, or you think about the advertising market, there are just these huge TAM opportunities that are ahead of Apple still, and everyone's very fixated on the quarterly numbers of the iPhone. I think it's time to step back and really take assessment of what are the long-term opportunities for growth, and those are some really huge potential TAMs. Okay. And we just, your prior guest was talking about the AI server chip market. That's another potential large market, right? So there are a lot of untapped markets for cash flows.
Well, what goes through my mind is, of course, are they the good guardians of capital? In other words, returning it in the form of share buyback relative to perhaps the perception is in other Mag 7 stocks that you're squandering it on moonshot ideas. So this is about governance and I would say prudence over capital. When it comes to innovation, Apple, they create products that we never knew that we ever wanted or needed. We've gone into the Gobi Desert, as it were, of innovation. We're in the desert at the moment. So where do you think their biggest bets will be on the innovation that we don't quite know that we needed yet? You've mentioned health and you've mentioned chips. As you look towards these big reveals later in the year, where do you think the biggest reveal could come?
Yeah, I would sort of look at innovation a little bit differently, right? And yes, I mean, an iPhone 15 versus iPhone 14, incremental for sure, right? But at the same time, when you look at an iPhone 11 versus iPhone 15, that's the order of magnitude improvement in camera quality, in microphone and speakers, and audio and spatial audio. So innovation is well and alive. It's not completely obvious on the surface of it. We think that a lot of the innovation actually is beneath the surface, right? And when you think about that, that's really, it comes down to their silicon innovation. And they've been designing more and more and more chips that are tailored to their needs, whether it be for spatial video, whether it's all the new chips they put in the Vision Pro, right? So there's this silicon innovation, and that takes time. It takes consistency. It takes 4 or 5 year cycles. So what we're talking about at Apple really is a vision into the future where they're currently working on projects that are 5 or 10 years out. That is the level of cadence you need for a company that's churning out, 200, 300, 250 million iPhones a year, right? So when you think about the next step really around innovation, what we think is that generative AI is going to be a huge catalyst. And why is that? It's because, not only do they have leading edge technology in silicon, they're going to embed more and more of that compute density locally. They have the best data on the planet about anyone sitting on device. So it fits Tim Cook's perspective on privacy, where nothing has to leave the device, but at the same time, you're able to really monetize that at 2 levels. One, from giving you a very good hardware experience on device, and secondarily, by enabling developers to really tap into this hardware and then monetizing it at the services layer. So we think this is a multi-step opportunity for in generative AI that's going to be a huge next catalyst for Apple.
Okay, well, I mean, we have the big reveal on the iPad. I don't think that's going to be the transformative moment in sales and volume, but it will be a mini curtain raiser. Can I just square off China? Many people come in here and they go, Wedbush Securities being one of them, Dan Ives going, he's an evangelist, he's a sinophile, the worst is past, and there will be better times ahead. You would also concur and say that the China woes are unfounded, but I would put it to you, we've got the same set of risks in China. The risk parameters in China have not changed, so what gives you the confidence to say that China, the concerns are unfounded?
So I think that we have to put the China concerns in context, right? When you look at China, it is still a ginormous market from a demand opportunity standpoint. You still have a lot of the middle class that is coming up in tier 2, 3, 4 cities where the amount of spending power is increasing. And if you think about Apple actually grew units in mainland China. Not in greater China, but they did in mainland China. And that is despite facing some tougher compares from a year ago and 3 points of currency headwind. So when you dissect all the numbers, the iPhone franchise in China is alive and kicking. Has Huawei taken some share recently? Yes. I mean, Apple has had free reign of the China market for 4 years when the U.S. put restrictions, and clearly Apple capitalized on that. Is there going to be some period of give back? Yes, there can be some period of give back. Does it mean that this is structural? No, we don't think that means it's structural. Apple will continue to innovate. We're not seeing a mix down even in China. Yes, there is some promotional activity, and every company does that at cyclical times of need, and so did they. And so when we put this into context, we think that longer term, this is a big opportunity, continues to be a big opportunity for Apple. We think that, again, like when you have a device that is capable of doing things truly to improve productivity, like the iPhone can when generative AI features are embedded in it, we do think that the China market and China consumers will embrace that. Form factor change has not been something that has happened recently. China consumers love that. We think Apple's going to do a foldable over the next several years, and that's going to drive increased interest in an upgrade cycle too. So it's just that I think people tend to look at it from a very static standpoint, whereas Apple is innovating behind the scenes and coming up with interesting technologies that will capture the fascination, we think, of Chinese consumers, apart from the global consumer base.
Okay, well, you made the call, Wamsi, and the stock certainly has responded after that buyback and the shift in the narrative. Wamsi Mohan over at Bank of America Securities. Breaking news on international paper now. A deal may be in the offing. Abby, what are the details?
Indeed, Manus, we do have breaking news. Reuters reporting that Suzana, the Brazilian biodegradable company, they consider themselves a bioeconomy company, has made a $15 billion takeover offer that equates to $42 per share. So international paper moving up toward those levels. At the high, international paper had been at 41.30 at that point, heading to its best day since March of 2020. Making this news perhaps more serious or more credible is the fact that the shares of Suzano right now down nearly 6%, heading to their worst day since December 13th, 2022, Manus.
Okay, Abby, thank you very much. Breaking news headline there. We bring that to you. Coming up, UBS returns to profit.
Actually, it's a good momentum. May remember in the fourth quarter, we also had a very strong performance in banking. As we integrate the new colleagues from Credit Suisse on our platform, we start to see the pipeline developing. We are able to execute.
We discuss the bank's latest earnings release right here on Bloomberg, where context matters.
We invest in, buy, and own the backbone of the global economy. When the water gets delivered to your house, the road you drive on, the pipeline that brings different things to your community, the telecom towers that transmit your phone, the data center, the real estate that you live in. It's what we own and build, so it's really what drives the economy, and you don't often see our name.
Is that a good or a bad thing?
You know, it's just because we're behind the scenes, but it's big with $1 trillion of assets almost. We're behind a lot of the things of the global economy.
So being low-key, do you think it gives you strength?
We just try to be quiet and do our thing, and sometimes it helps and sometimes it doesn't. But I'd say on balance, it's been good for us.
You were offered a money-losing women's basketball team, and you said, I want to be in the other sports as well. Is that right?
Well, yeah, you know, you got to be smart about this.
Good morning. This is Bloomberg Surveillance.
This is Bloomberg Daybreak Europe.
You're watching The China Show. This is Bloomberg Technology.
This is the countdown to the close.
Welcome to Balance of Power. This is Bloomberg.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Very good progress on our integration plans, but also it was great to see a very strong return on to profitability, both on a reported basis, but also very strong underlying profits. We also see a good momentum with clients, with inflows across our businesses, and our capital is strong, so allowing us to continue to pursue our capital return plans. Actually, it's a good momentum. may remember in the fourth quarter, we also had a very strong performance in banking. As we integrate the new colleagues from Credit Suisse on our platform, we start to see the pipeline developing. We are able to execute. And so it's very much aligned with our expectations of improving the mix between our markets business and our banking business in the investment bank.
UBS returns to profit after its rescue of Credit Suisse. The move reversing 2 loss-making quarters thanks to the strong performance in managing wealth and investment banking. Tom Metcalf is with me. So the lean into FX over rates didn't injure them, but the real growth, Amati says, came here in the US and in Asia. Tom, good morning.
Hey, good morning. Yes, very strong quarter for UBS. You can see that in the shares. I think they're up about 9% at the moment. As you say, lots of growth areas, pretty much a clean bill of health. And, you know, profit really trumping those estimates from analysts. I think one thing to keep in mind is some of this is accounting driven relating to this integration of Credit Suisse. So their legacy unit did very well this quarter. That's not necessarily sort of sustainable quarter in, quarter out. But by and large, you know, shareholders will be very happy with this and the sense that UBS is sort of moving ahead, integrating Credit Suisse and finding ways to bring in more clients.
They are indeed, and they're already, I mean, the big debate is the amount of extra capital that the regulators, pressured by the government, they're going to make. And he's saying we've already started adding about $20 billion in capital, and it's too soon to jump to conclusions. But of course, everybody salivates, especially on bond desks, about the size of their bonus. We're now at the end, we're midway through second quarter, and it's going to be the traditional, as it were, people at the table: bonds, equities, fixed income, investment bankers. Who's going to get the best bonus, Tom? How's it shaping up?
Yeah, some really interesting data from a report looking very early at 2024 bonuses. And, you know, if I could switch jobs, it looks like I should become a debt underwriter because they are up something like, or thinking they get bonuses up about a quarter at the high end of things. So very strong performance there. As you say, the bond traders there or thereabouts, 15% or so. One of the things that caught my eye was actually the investment bankers. You know, we're seeing deals come back, but because they're on a bit of a lag, because those deals take a while to actually complete, even though we're getting all these positive headlines, this report, at least from Johnson Associates, is saying their bonuses will be so-so this year.
Okay, Tom, thank you very much. Tom Metcalf there on the very latest thinking for UBS and your bonus. Coming up, sector price action for the morning. Let's get across to Abby.
So a few interesting things going on, Manus. First of all, we have the S&P 500 up slightly, up 0.1%, but that means the S&P 500 is up for a 4th day in a row, the longest winning streak since March 21st, and that's right before we started to see the weakness. So the bulls, the near-term dip buyers, trying to take out the sellers. It hasn't happened yet, but you can also see it's on breadth. Consumer staples up 1%, real estate up 0.9%. A lot of sectors higher today. To the downside, tech and discretionary, but down ever so slightly, down to a greater degree, and I'm not entirely sure what's behind this. The NASDAQ Golden Dragon Index today is down more than, it had been down more than 2%, right now down about 1.9%. This may be after a period of strength, a little bit of selling there for some of those China tech ADRs, Manus.
Okay, Abby, thank you very much. Coming up on the show, market moving events to set your clock by. The Trading Diary on Bloomberg.
Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, context changes everything.
Force is strong, the Fed is with you. That's the narrative in the market. This is 5 days that changed the bond market's thinking. We're down by 23 basis points. It's the same right the way across the curve. Part of that bond market repricing is transferred into a quasi-floor on the equity market. You get some pretty big moves in the equity market this morning. We're putting in a firmer footing across the board, flat on the NASDAQ. The Russell, again, playing into this narrative that you will potentially get rate cuts. One stock to keep an eye on is Disney. It's not so much the subscriber base. That's where the market first hung its hat on this morning. It's about the reality of what it costs you to go to Disney in the United States of America relative to Asia and relative to France. The stock is down now, as you can see, by over 8%. Let's get you set up for your day ahead. This is what you need to know for your trading diary. We've got the Minneapolis Fed President, Neil Kashkari, joining the team, 11:30 a.m. Eastern Time. And then it is all about the bond auctions. As I say, $58 billion of threes. That's at 1 p.m. They turned up in size for the 6-month and 3-month bills yesterday. Uber earnings on Wednesday. Fed speak, more of it on the same day. Jefferson, Collins, and Cook on Thursday. And finally, the Bank of England, the rate decision, that hits the tape. That was countdown to the open from New York right here on Bloomberg. All the volatility and all the flow. Good morning.
Also an owner, I should have pointed out, of 3 major sports teams.
That's right.
And you're the first woman, as I understand it, the first woman to own 3 major, have stake in 3 major sports teams. Is that right?
Yes, and we'll say African American.
You were approached by the owner then of the, I guess, the Washington Wizards and the Washington Caps about maybe buying the Washington Mystics, which is the women's basketball team. And what did you say?
Well, first of all, it was Abe Pollin. He did come to me and Susan O'Malley, and they said, Abe Pollin says, look, I want you to be the face of the Washington Mystics. And I said, what do you mean be the face of? He says, I want you to buy this team. His health was failing. And I have to tell you, and a lot of women can understand this, we never get these opportunities. So that was the first thing that struck me, and I was flattered. I was really flattered. I said, well, Abe, what are the financials on this? And handed them to me. He says, well, they're not making money. But I was still intrigued about team ownership.
Bloomberg Surveillance covers the latest in global markets and the political events that influence your world. Join Jonathan Farrell, Lisa Abramowitz, and Anne-Marie Hordern only on Bloomberg. Context changes everything. Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
Great question. Great question. That's a question I get all night.
Bloomberg, top experts, great questions. This is Bloomberg Intelligence with Alex Steele and Paul Sweeney.
The real outperformance has been the U.S. corporate high yield.
Are the companies lean enough? Have they trimmed all the fat?
The semiconductor business is a really cyclical business.
Breaking market headlines and corporate news from across the globe.
Do investors like the M&A that we've seen?
These are two big-time blue-chip companies.
The window between the peak and cut changing super fast.
Bloomberg Intelligence with Alex Steele and Paul Sweeney on Bloomberg Radio.
All right, good Tuesday morning from the Bloomberg Interactive Broker Studio in New York City to our worldwide audience. We're streaming live on YouTube as well. This is the Bloomberg Intelligence program. We focus on companies, stocks, bonds, all that kind of good stuff, as well as the markets. We lean heavily on the 400 investment professionals at Bloomberg Intelligence. That is the in-house research department of Bloomberg LP. And Bloomberg Intelligence covers 2,000 companies, 130 industries. We lean heavily on those folks throughout the next couple of hours. Coming up, we're going to check in with Geetha Ranganathan. She covers the media stocks for Bloomberg Intelligence. Get a sense of why Disney's down 8%. I thought those numbers were pretty good, but we'll check in with her. Mandeep Singh, Bloomberg Intelligence senior tech analyst. I think they're launching a new Apple iPad today. We'll see about that. We'll also ask them about maybe Uber and all that Instacart kind of stuff. So we sent Alex Steele back to her desk, rest. She worked for 3 hours
this
this
was a
morning.
trade.
Yes, it was a trade.
Did
and
we get
in
the
that
better
trade,
part of it?
You guys got the bum end of the deal. But we'll make do with this. There's a player to be named later also, John. Tim Stenovic sitting in for Alex for the next couple hours. We appreciate getting some of Tim's time. And there's a lot going on out there, Tim. We're going to get to it all. And we start off by going to Mr. John Tucker and getting a Bloomberg Business Flash.
All right, and this report being brought to you by Interactive Brokers. Interactive Brokers charges U.S. dollar margin loan rates from 5.83% to 6.83%. Rates subject to change. Learn more at ibkr.com/compare. But right now, 9 of the 11 major industry groups in the S&P 500 are higher real estate, consumer staples, best performing groups. You have information technology. That is the biggest drag, and that's where you're going to find shares of NVIDIA. They're down 2.6%. Shares of Walt Disney, you're going to take a deeper dive into this with Geetha Ranganathan a little later. That's the number one laggard in the Dow Jones Industrial Average after their earnings report down 8.3%. Then you have news that Instacart partnering with Uber Technologies to offer restaurant delivery through Instacart's app. That's taking on DoorDash. Shares of DoorDash, ticker symbol Dash, down 2.1%. Government debt sale today. We have today a U.S. auction of $58 billion of 3-year notes. And your earnings scorecard, after 425 of the S&P 500 have reported so far, you have 80.14% delivering positive earnings surprises. Apple shares most actively traded in the market so far, reportedly working on their own AI chip. That's according to the Wall Street Journal. S&P 500, 6 points higher. That's up 0.1% right now. 51.87 after yesterday's 1% pop for the index. The Dow Jones Industrial Average, 80 points higher. That's up 0.2%. And the NASDAQ Composite Index right now, that is down 7 points. We check the markets for you all day long right here on Bloomberg Radio. I'm John Tucker, and that's your Bloomberg Business Flash. Tim and Paul.
John Tucker, thank you so much. We appreciate it. Tim Stenovic sitting in for Alex Steele. Alex Steele was sitting in for Tom Keenan. It all works. We all figure it out. We're here in our Bloomberg Interactive Broker Studio. We're streaming live on YouTube as well. Tim, thanks for joining us again today. What are you looking at here this morning?
Well, I'm looking at Disney. I'm looking forward to talking with Geetha about that. I'm also watching shares of Peloton because
Yes.
there's that CNBC report a little earlier. Yeah, there's a lot to watch because it's also earnings.
Yep.
Got some big earnings yesterday that are still moving the market. What are you watching?
Well, you mentioned the Peloton. We saw that story. Reuters had it initially, CNBC had it initially. But I'm a big Peloton user,
Are you?
so I'm very interested in what's
You
going
use
on.
it more than just for a clothes drying rack,
Yeah,
right?
well, my
Because-
girlfriend's every single day on it. She's a mad person. So we've got the bike, we've got the treadmill thing. We're all in. But
You're who they want.
Yes, and they need to figure out a way to monetize me besides the whatever month we've spent. Whether it's advertising,
Yeah.
merchandise, they need to figure out a way. That's kind of I think the future of this company. So we'll see what happens. So we'll see if private equity takes a look at that. So a lot going on out there. The market's pretty quiet in terms of the indexes. The S&P up about 0.1%. But let's check in with Nora Melinda because she follows these equity markets for Bloomberg News, and she joins us here in our Bloomberg Interactive Broker Studio. Nora, what are you looking at?
Let's start off with Disney. Of course, that's the big name of the day. We're going to be hearing all about it throughout the trading today. But Disney Plus streaming subscribers fell short of analyst expectations. We have Disney shares falling for their biggest drop since November of 2022. Now, subscribers totaled 153.6 million, but the street was looking for 155.7. And the profit outlook also came up short of analyst expectations. They did raise the guidance for the full year earnings growth to 25% from 20%, but analysts were looking for 25.5. So a bit critical here. We saw an earnings beat with earnings coming in about $1.21 per share versus estimates of $1.12 per share. And despite today's sell-off, as we are seeing this big drop, this is the fourth straight quarter of results for profit that beat expectations. So that could be a sign that there is a potential turnaround under the leadership of Bob Iger. So, different ways that you can look at this report here.
Okay, interesting. We'll check in with Geetha and get some of the feedback. She was on the conference call this morning. So.
Okay, Nora, I also want to talk about Palantir. I know this is on your radar. I hit the earnings right when they crossed yesterday at 4 o'clock. Numbers were pretty good, but the investor reaction is not so good.
It's not at all. We are seeing the shares of Palantir falling as much as 14%. Now, that is the biggest intraday drop since 2022. The company boosted its revenue forecast for the full year, but investors were looking for more. They saw their revenue of $2.68 billion to $2.69 billion, but the estimate was $2.68 billion. So investors really have some high expectations for the company, and it seems as though they aren't meeting the high mark that they're looking for.
Yeah, the stock was up 40% going into the print. It was up over 10% just in the last week ahead of these numbers. So it just shows, Paul, that expectations are really high for some of these companies.
Yep. Dan Ives, Uber bull out there on all things technology. He's been bullish on Palantir. He's when he initiated coverage maybe 6 to 9 months ago, he said this is one of his AI calls. It's a derivative of a derivative of AI, but he says it's a good AI play. All right, anything else?
Well, we have to look at Peloton.
Okay.
You're a user,
Yep.
so I got to touch on that one. As you mentioned, there was that CNBC report that came out that says a number of private equity firms have been considering a buyout as the fitness company looks to refinance its debt and then hopefully return to growth after 13 straight quarters of losses. Of course, we know this has been a pretty beaten down stock. We are seeing it up for its biggest jump since November. And just last week, of course, we do know that the CEO, Barry McCarthy, announced that he'd be stepping down, and the company said that it would be planning to cut 15% of its staff after that disastrous earnings report that we did see. But the stock is getting a bit of a pop. It's up as much as 18% this morning in trading on the news that CNBC says that a number of private equity firms are considering a buyout.
Okay, we'll see how that plays out. It seems like a good brand to me. I don't know.
Yeah, we'll see what private equity could do with it.
Yeah, exactly right. All right, Nora Melinda, thank you so much for joining us. Nora covers all the equities for Bloomberg News. I've been covering Walt Disney for 35 years. There was a time when I got paid for my research on Walt Disney. So, of course, I looked at the results this morning and said, this stock will trade up, down 8%. So what do I know? So let's go to somebody who's much smarter than any of us here about this kind of stuff. That's Geetha Ranganathan. She is the media analyst for Bloomberg Intelligence. Geetha, what does the street not like? I thought it was a pretty good print there for the company.
It certainly was, Paul, but what the street didn't like was the outlook.
the outlook for the fiscal third quarter, especially for the theme park business, was definitely weak and not something that the street was expecting. So consensus had a 12% growth in operating income for the parks business. What Disney said, 0 growth.
Wow.
And that kind of really spooked investors. And they talked about different aspects here. They said that they have, 3 new cruise ships that are basically coming on board, and there are launch costs associated with that. They're also opening this new kind of private island along with their vacation club and cruise business. Of course, that also is contributing to that. But I think what really has investors super nervous at this point is that they spoke about a moderation in demand, and this has been a constant question for Disney. Can that park's momentum sustain, and how long can it sustain, and will they have pricing power? And I think this is where you're kind of seeing the negative reaction come in, because people are not so confident anymore.
Is the moderation of demand about Disney's lack of exciting things to draw in people to the parks, to draw people to the theaters, or is it about a story that has to do with the consumer and the way that the consumer feels strapped?
I think it's a little bit of everything, Tim. So, definitely the consumer, the overall health of the economy and the consumer for certain, and, tremendous inflationary pressures. But of course, for Disney, one thing that they've done over the past few years is they've really raised prices in their parks pretty dramatically. And it's becoming increasingly expensive for, a family vacation. So, to the point of almost becoming prohibitive. And, that's where kind of that whole pricing power question comes in. I think they're going to have to do it much more cautiously and gently in the future.
Paul, talking to some neighbors the other day who recently took their kids to Disney. Yep. They were adding up how much it cost for just a couple days down there. They were saying probably about $5,000 is what they spent in Florida. Wow. 2 kids, a few days down there. Wow. It's a lot of money.
And you need an advisor to set all this stuff up because it's so complicated.
Yeah, so I've heard with these
I just called Geetha. She makes a phone call, and I'm like the front of the line every time. Geetha, the other part of this story, and for the longest time, the last 4 or 5 years, has been their streaming business. And when will that business turn profitable? They had some pretty good news on that front, didn't they?
They did, Paul. I mean, we're just on the cusp of a major earnings inflection point here. For the first time ever in the streaming business's history, they actually posted a modest profit. Now, again, they said fiscal third quarter, which is the next quarter, is going to be a little bit choppy. But then what they've said all along is that expect some really good results in the fiscal fourth quarter, and then they're really going to build on that starting in fiscal 2025 and beyond. They have a lot of initiatives in the works. They're cracking down on password sharing a la Netflix. And remember, that has been a huge growth story at Netflix. Netflix added almost 35 million subscribers after they started cracking down on password sharing. So Disney can also hope to see quite a lot of success with that. And then, of course, they also have the Hulu integration as well as, the ad tier, all of that kind of contributing. So streaming, I think, is going to be a considerable source of earnings upside in the next few years.
How's Bob Iger doing?
He's having a successor.
He spoke about that actually on the call that came up, and he said that they're kind of actively considering. They have 4 internal candidates, all of the division chiefs that are kind of up for consideration, and he said that they're looking at them very carefully, and the announcement will come when the time is right.
Is this any replay of what happened a few years ago when Bob Chapek took over? I mean, it kind of sounds familiar. A number of internal candidates, the person gets picked, the other ones leave, and then Bob Iger comes back because it didn't work out.
Yeah, I mean, we've seen this movie play out so many times now at Disney. I hope, and I think this time it really will be different. I mean, that was the whole bone of contention, for the activist investors, including Nelson Peltz. And I think having this new succession planning committee suggests that this time they will do things probably a little bit differently.
All right, Geetha, so clearly looking at the stock down 8%, the market clearly is focusing on that theme park business, and for good reason. It's become, kind of under the radar. It's now become 70% of their operating income. So it is the business here. What did the company say about their ability to potentially deal with maybe weaker demand? It's been a long time since we've seen them ever cut prices at the theme parks, promote, at the theme parks, anything that would hurt profitability. It's been a long time since they've had to do that.
Yeah, I mean, the theme park business has been such a consistent story for them, Paul, as you just pointed out. They have 25% operating margin in that business. And they are really looking at this as a future earnings growth driver, which is why, they're investing $60 billion in the theme parks over the next 10 years. Over half of that is basically just adding capacity, adding new attractions, and I think it's a really timely and a good strategic move. They're also bringing on those cruise ships that's going to cost them about $12 to $15 billion. So they're definitely adding capacity. So I think overall, definitely the business is in good shape, but in the near term, obviously the sentiment has definitely soured.
Well, speaking of souring sentiment, curious about the media business here. Apart from streaming, the legacy media business, talking ESPN, talking ABC. What did we learn about that business?
Bad. Okay. So legacy TV networks, the operating income was down 22%. Wow. That's not surprising, but it's just the rate of decline. I mean, we were expecting, maybe high single digits. This is really bad. And what gets worse is, we're obviously hearing about all of the sports rights negotiations that are ongoing. If you look at the NBA deal, for instance, that's basically looking at tripling the sports value. So their previous deal was about $25 billion. New deal will be over $75 billion. And so these companies are going to have to pay up just to kind of maintain the status quo, or maybe not even maintain the status quo in their TV networks business, which is really going to crimp profitability pretty significantly.
So, I mean, it begs a question. Your costs are tripling. Your revenue's not tripling. Is streaming going to pay for all these sports rights? How does a company even position that in the marketplace?
That's what they're betting on, Paul. I'm not sure that streaming is going to be able to reclaim all of that leakage that we're seeing on the linear TV side, but they're definitely betting that it will be able to salvage some of those losses. So, ESPN, for instance, they are having obviously their new standalone app that is going to come out sometime in 2025. And then they have this new sports JV that, again, is supposed to come out a little bit later this year, along with Warner Brothers Discovery and Fox. So they're doing different things. Again, not sure whether how successful it's going to be. That's still a little bit of a wait and watch.
Geetha, we're so lucky we have you because you not just cover Disney, but you also cover Peloton. And shares of Peloton higher by 12% right now. This after CNBC reported that a number of PE firms have been considering a buyout of the company. They cited people familiar with the matter. What could a private equity firm do with Peloton? Like, how could a PE firm make Peloton successful, solve its problems?
Cut costs. I mean, that's what PE firms do best. And Peloton really has had a huge cost problem. And the cost problem is because the costs haven't really been aligned to its revenue base. Its revenue has been steadily decreasing, just a combination of different factors: weak demand, a saturated market. Their new products haven't really taken off. They've tried all kinds of different things with a whole new digital app revamp. Again, that's really not done the way that they wanted it to kind of perform. They have all these other partnerships with Lulu. They had this new hotel partnership. Again, nothing has really been a game changer, but the costs are still very, very high. And that's just because it's cost them so much to manufacture their equipment. And so PE can kind of really come in and trim that cost base.
All right. Geetha, thanks so much for joining us. Geetha Ranganathan, she is the media analyst at Bloomberg Intelligence, folks. She is, over the last 15 years, has built up an amazing franchise on Wall Street as being one of the leading research voices on that space, and it's been undergoing a tremendous amount of generational change in the media business, from the traditional cable TV, satellite delivery mechanisms to this whole thing called streaming. It's required a lot of work, and a lot of folks on Wall Street pay attention to Geetha's research. You can find Geetha's research and all of the Bloomberg Intelligence research on the Bloomberg terminal. BIGO is the function that'll get you there. It's good stuff. Disney stock down around 7-8% here. Again, concerns about maybe peak theme park demand there coming out of the pandemic, maybe getting back to a more normalized level of attendance. But what we've seen over the years from Disney is they really know better than anybody else how to price their theme park product and how to invest in and how to generate returns. So longer term, I think a lot of people feel pretty good about that. Coming up, Sandy Brigger. She is the Chief Client Officer at Aspiriant. We'll get her market call here as we digest these quarterly earnings and think about what the Fed's next move. S&P 500, it's up about 0.2% here this morning. We'll keep an eye on these markets. This is Bloomberg.
markets, headlines, and breaking news 24 hours a day on Bloomberg Radio, Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
And I'm John Tucker in the Bloomberg Newsroom with this Bloomberg Business Flash. The stocks right now are mixed. The major averages with the S&P 500 up 7.5 points. Treasury yields, they're lower. That's good enough ammunition to keep stocks higher. And after yesterday's 1% jump for the S&P 500, you have 8 of the 11 major industry groups in the index up right now. Materials, real estate, consumer staples, the best performing stocks. The worst performing group that belongs to consumer discretionary, and that is home to Tesla. Those shares down 3% right now. Preliminary data from the China's Passenger Car Association showing shipments from its Shanghai factory dropping 18% year on year in the month of April. And they have Walt Disney shares right now 9% lower after their earnings report. And as far as treasuries, the 2-year yield right now 1 basis point lower. That's at 4.81. The 10-year is 5 basis points lower. That is at 4.43. And we check the markets for you all day long right here on Bloomberg Radio. I'm John Tucker, and that is your Bloomberg Business Flash. Tim and Paul.
All right, JT, thank you so much. We appreciate it. Paul Sweeney, Tim Stanovic here sitting in for Alex Steele. We're live here in our Bloomberg Interactive Broker Studio. We're streaming live on YouTube as well. In my next life, I'm coming back and going to college at the University of California, Santa Barbara.
Oh,
Jesus, what a
You know, I grew up. I grew up
scam.
just a few miles north of that.
Oh, did you?
Yeah, San Luis
right.
Obispo. I'm part of the 805 crew.
Okay, very good. I mean, what was I thinking? Anyway,
You can't tell because I'm so chill.
Yeah, exactly. That explains it. That explains it. Our next guest, Sandy Brigar, joins us. She's the Chief Client Officer at Esperient, joining us live here in our Bloomberg Interactive Brokers studio. Sandy, it's funny, this market here, a lot of folks, you know, we had that nice run off those October lows. People felt like maybe the market got ahead of itself, and then we had the Fed saying, gee, maybe we're not going to cut rates, maybe we're going to hike rates, and people got a little spooked there for a while, but it seems like we're back on a positive trajectory here. How do you guys think about the markets and maybe get away from that day-to-day type view of the markets?
Yeah, it's hard to get away from the day-to-day, especially when it's bouncing around so much, and depending upon the day, you have a different view of what's happening. But our clients are corporate executives, family business owners, entrepreneurs, inheritors. They're really thinking about their portfolios for the long term, and they're not so worried about what's happening on the day-to-day, so that takes a little bit of pressure off of us, although we get questions about the day-to-day all the time. Our best advice to our clients is really to be prepared for anything in this market. So we're playing both offense and defense simultaneously in portfolios, just being prepared for a range of outcomes.
What are the types of questions that you're getting? Like when your phone is ringing, when your email inbox is pinging on days when we're seeing volatility, what's the question that your clients are asking?
It's either, should we raise more cash or should we put more cash in?
I mean,
and it might be the same question from different people in the same day.
And let's be honest, like when the question is, should we raise more cash? Your job is to say no.
We think it's really important to be invested, and because we're putting together an investment portfolio based on our clients' financial plans, we have a good sense of how much cash they need at any given moment. So everything else that they don't really need for the near term, we are recommending that they invest. And we talk about why we're investing the way that we are and really help hold clients' hands through that moment. Now, for the clients that are willing and wanting to put more money in, that's actually a good sign, because for a while people were so excited about yields on money market funds. You know, hadn't seen any return on cash in so long that people were feeling really comfortable bulking up on cash, and so now they're ready to get invested, and those conversations go well too. Interestingly, we've started having clients take steps into bonds on the longer term side. We think that in this environment where rates are high, it's nice to lock in some of the current rates. And if we do see some softening in the economy, that should do well for bonds, high quality, intermediate, long-term bonds. And then on the equity side, we're really focused on where are the opportunities. And we think because of the narrow range of the market over the last 6 months, that there's plenty of interesting stocks out there that haven't rallied. And it does look in recent days like maybe that's opening up. So we're excited about that.
When you say playing offense, what does that mean to you guys?
So looking for opportunities to invest where there's a high likelihood of achieving a good return on that investment. So for us today, that would be in value stocks here in the U.S. and overseas. I would say about 55% of our overall equity allocation is overseas right now, with a fair amount in emerging markets. Yeah, because I mean the U.S. has just been so strong. Things are happening differently outside of the country.
Is your argument that there's like a reversion to the mean here? Or because if you look at the past decade, I mean, the U.S. has outperformed everywhere else.
Yeah, valuations are so high, and
it's been ugly if you've been overweight international.
It has, but we think there are great opportunities, especially as things get pricey here in the U.S. When we look at valuations, we really do see some great opportunities overseas.
Okay, then conversely, if I'm playing defense, what does that mean to you guys?
So defense today is a fair amount of bonds. You know, for the last several years, we weren't putting very much emphasis in bonds and portfolios as rates were increasing. We think, you know, we have no idea what the Fed will do, but we think we're much closer to a Fed rate shift than we are to more increases. And so we think fixed income is a good place to be. We think it's going to play its traditional role in a portfolio, helping buffer to volatility and provide some solid returns. And right now, returns are about 2% after inflation, so not so bad.
Okay, so somebody comes to you with a pile of cash right now. They say, I need you to put this to work. Where do you put it to work? I know it depends on their time horizon, how old they are.
Yeah, so we're going to do
individual
a full comprehensive
circumstances.
plan, but assuming that there are folks with a long investment time horizon, we're probably putting about 55% of the portfolio in equities, as I said, with about half of that, a little more than half overseas. The rest of the portfolio we're managing defensively, so maybe 35% in bonds and 15% in liquid alternatives, because we do think that they're nice buffers for volatility as well and provide a different...
Did you say illiquid alternatives?
So liquid alternatives.
Liquid alternatives,
yeah,
okay.
Liquid alternatives.
So what is it? Like, I guess I was surprised. We were doing a remote broadcast of one of our RIA sponsors, and I was surprised that the average RIA out there, they're saying that registered investment advisor, they're saying that their clients really have an interest in alternative investments, like more than the 5% or 10% token that I would suggest, like much higher. What are you seeing in terms of demand for alternative investments, whether it's hedge funds or private equity or any of that kind of stuff? And then where do you steer your clients?
Yeah, so in terms of the more hedging, that's what we're doing in the liquid alternatives portfolio. So clients are feeling good about that. But we have seen in recent years a bigger interest in private equity than ever before. And we think there is definitely a great place for private equity in portfolios. But we're really looking at portfolios that are $20 million and up, where people can really have a long investment time horizon and take some risk with their portfolios. Because even though people have been really excited about PE, there's very few winners in that crowd.
But I wouldn't consider private equity liquid by any means.
No. So that would be in a liquid portion for sure, which is also why we're looking at clients with the much bigger portfolies for that.
Who is a typical client for you guys?
So corporate executives, family business owners, inheritors.
See, I need to be an inheritor.
I was going to say, I don't remember that being a choice when I was majoring in school. Like,
inheritor.
Nobody ever said, hey, inheritor could be something you choose career-wise.
Do you guys buy off on this whole thing? Like, I guess I had to read a lot about the baby boomers have so much wealth, and how do they get it to the next generation?
The great wealth transfer.
Yes.
Yeah,
exactly.
that is in motion, and we spend
I tell my kids, the last check I write is going to bounce, baby. That's how you do it.
That is a strategy. Yep. That is a strategy.
I like that.
But it is a conversation we're in with many of our clients, and it actually presents some really interesting investment opportunities, because when they are transferring assets out of their estate for the rising generations of their family, that's money that has a very long investment time horizon, and so they can get quite risk-loving if that's the direction that they want to go in.
Okay, typical portfolio size. For
you
guys.
25 million.
Okay.
Yeah, I think that's our.
And is it
25 to 50 million.
60-40 plus we allocate some alternatives? How do you start? I know it probably depends on the individual, but do you start like 60-40 and then decide how much you want to take away from that, put to alternatives?
So we do take a valuation-driven approach. So our allocations are based on where we're seeing valuations in the market. So we don't have a fixed asset allocation. We have dynamic ones where clients give us the discretion to move within bands. So today, as I was mentioning, we're more like 55, 45 sort of allocations on average, but there's a very big range. And then for a client, when we're looking at their investment portfolio, there's a lot of conversation that we're having with them, not only about their goals and what's most important to them and their long-term plan, but how are they feeling about investment markets? How have they reacted in the past when markets have gone south? Really trying to help hone them in on what's the right place on the risk-return spectrum for them.
Are you running into any challenges from clients coming and saying, look, I've seen how the S&P 500 has performed over the last 10, 12 years. Had I just put my money in VOO, it would have outperformed my portfolio?
There are some clients that feel that way, and a lot of conversation about, again, where are you relative to your plan, and was the objective to get the highest return? Because in retrospect, it's really easy to see how we could have gotten there. But we've been living through very interesting time periods, and what we've seen in the recent past, we don't expect to continue going forward. So lots of conversations with clients to help meet them where they are and get them through these markets.
Sandy, thank you so much for joining us. Sandy Bragar, she is the Chief Client Officer for Aspirant, based in San Francisco, California, but joining us live here in our Bloomberg Interactive Broker Studio. Appreciate her making the trip all the way across the country just to see us. Go figure. S&P 500 unched on the day, up about 0.1%. The Dow up 100 points. That'll get you 0.3% of performance here. The NASDAQ off just slightly as well. Yields coming in modestly. The 10-year Treasury's in about 5 basis points. Let's call it 4.43% on your 10-year. WTI crude oil off a little bit here today, just below $78. Gold kind of steady here, $2,320 per ounce. And Bitcoin steady, 63,300 on the cryptocurrency. With our news in New York City, here's Michael Barr.
Thank you very much, Paul, Tim, and John. Adult film star Stormy Daniels is expected to testify today at Donald Trump's criminal hush money trial. However, the first witness today is an editor from Penguin Random House as a custodian of records. Daniels, whose real name is Stephanie Clifford, claims she had an affair with Trump a decade before his 2016 election. Trump is accused of falsifying business records to cover up the sexual encounter with Daniels. He denies any wrongdoing and said today that he entered the expense properly as a legal expense.
The trial is a very unfair trial. It's a very, very unfair trial. The good news is they have nothing.
Yesterday, the judge warned that the ex-president could face jail time if he kept violating a gag order. Ukrainian authorities said they foiled a plot to assassinate President Volodymyr Zelensky and other high-ranking officials, making the announcement on the day of Vladimir Putin's inauguration in Moscow. The prosecutor general's office says 2 colonels with Ukraine's Department of State Security, the special unit responsible for protecting government officials, have been detained on suspicion of high treason. Republican Congresswoman Marjorie Taylor Greene says she plans to meet with House Speaker Mike Johnson again today. Yesterday, they met for nearly 2 hours. Greene will be joined by fellow Republican Representative Thomas Massey. The two have threatened to oust the Speaker. Greene spoke to reporters yesterday.
I have been patient, I have been diligent, I have been steady, and I have been focused on the facts. And none of that has changed.
Speaker Johnson.
I had a lengthy, constructive meeting, I think, with Thomas Massey and Marjorie Taylor Greene. We have discussed some ideas.
Global news 24 hours a day and whenever you want it with Bloomberg News Now. I'm Michael Barr, and this is Bloomberg.
markets, headlines, and breaking news 24 hours a day on Bloomberg Radio, Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
And I'm John Tucker, the Bloomberg Newsroom with this Bloomberg Business Flash. We're being brought to you by Commonwealth, supporting more than 2,000 independent financial advisors with the solutions they need to grow a thriving business. Commonwealth, go where you grow. Visit commonwealth.com to learn more. You have 9 of the 11 major industry groups in the S&P 500. They are higher right now. Real estate, consumer staples, best performing. And then you have information technology. That is the biggest drag right now. That's where you're going to find shares of NVIDIA. They are down 2.5%. Shares of Walt Disney, number one laggard in the Dow Jones Industrial Average. Disney shares down 9.6% after their earnings report disappointed investors. You have news that Instacart, partnering with Uber Technologies, offer restaurant delivery through the Instacart app. They're taking on the food delivery app DoorDash. As a result of all this, you have DoorDash shares down 2.25%. Government debt sale today. We have an auction of $58 billion of 3-year notes. S&P 500 right now up 7 points, a rise of 0.1%. We're at 51 to 87 on the index. The Dow Jones Industrial Average up 94 points, up 0.25%, and the NASDAQ 100 up just 3 points right now. 2-year yield, 2 basis points lower, 4.80, and the 10-year right now down 5 basis points. That's at 4.43% yield. And we check the markets for you all day long right here on Bloomberg Radio. I'm John Tucker. That is your Bloomberg Business Flash. Tim and Paul.
All right, John Tucker, thank you so much. We appreciate it. Tim Stanovic and Paul Sweeney, we're live here in our Bloomberg Interactive Broker Studio, streaming live as well on YouTube. So head over to youtube.com and search Bloomberg Podcast, and that's where you'll find us. All right, well, long-term investors in and observers of Apple know that a big part of this story is product refreshes, new products, the newest versions of the iPads and the iPhones and the watches and all that kind of stuff is important for this company. And Apple had an event today where they unveiled some new iPads. So the question is it time to upgrade your iPad? Mandeep Singh joins us here. He covers all the technology stuff for Bloomberg Intelligence. Mandeep, looking at Apple shares up about 0.5%. Talk to us about the new upgraded iPad. What is it, and how important is it to the company these days?
Yeah, I mean, look, iPad line is about a high single-digit contributor to their overall revenue, so not as big as the iPhone, of course, but clearly, they are trying to put their latest chip in the iPad. They showcase a new keyboard for the iPad, and there were other battery enhancements, new OLED display. So all these are cool, but fundamentally, you have to ask yourself, is it, worth to upgrade to a new iPad with all these incremental features, as I would like to call? And that's where I think the market is anticipating more along the lines of what can you show me in terms of AI and the wow factor around LLMs. And I think that's what was missing at the event.
Well, what could they show? I mean, when we talk about AI and Apple, what are we thinking about? Because Mark Gurman says that this is an AI-focused Pro model. So I'm wondering, apart from the chip, what about it is AI?
It's at the app level. So that's why that operating system upgrade, and they did talk about the iOS 18. Look, right now, the current version of my iPad, which is 5 generations behind what they launched, can run the latest version of the iOS operating system. So why do I need to upgrade? They have to give me a reason to upgrade to the latest iPad because my current version can't run the operating system, and it's got some cool apps. That is what was missing. Like, what functionality can you show me around Siri, around image editing, around summaries? Like all the cool stuff that we talk about from NVIDIA at the data center level. That's what a small kind of version of it is what you want to run on device instead of going to the cloud. And that's what they got to showcase in terms of why you need to upgrade to the latest hardware.
Okay, so Paul, this is not our first rodeo. No. You and I have anchored before. And one thing that's different than versus a few years ago, when I would walk in here, you would have an iPad next to you.
Yep.
And the iPad, you told me, was like a really big part of how you prepared for the show. You used the Bloomberg terminal on the iPad. You also have the 2 screens for the terminal. You have no iPad anymore.
Nope.
Why not?
I still have the iPad, although it's probably the original version, but now everything's on the phone. I mean, you know.
So your phone has replaced your iPad?
Absolutely. And I have a very long train ride every day, which I need a very engaging device.
And your phone is that. It's not the iPad. So Mandeep, how big of a problem is that for Apple?
I mean, look, in their case, some of their newer products do cannibalize. You know, if the iPad is very good, it's going to cannibalize the Mac sales. And if the iPhone is very good, it's going to cannibalize the iPad sales. So that's always been the case, but it's still a very sticky operating system and, you know, just ecosystem overall. The only problem that I think people are trying to grapple with here is what is the refresh cycle? Because right now the refresh cycle continues to get longer and longer. It's not as if, you know, people are moving out of the ecosystem, but they're not gaining more Android users because they don't have the best looking phones or the best features that Android phones can offer. And so that is the part that is hurting their refresh rate and also the share gain from Android users.
June meeting, their developer meeting, anything on the wow factor? I mean, are they going to, is there a chance in their June developer meeting that they're going to come out with something that's going to blow the street away, or expectations low?
I mean, I'm expecting more emphasis on the software side in that developer meeting, and clearly they need to showcase what they are doing around the LLM strategy, whether an LLM, large language model, will be part of their OS, and then how it influences the overall app ecosystem. Because those are the features. If you look at the latest Pixel phone, they offer you a lot of those features already on Android. And that's what the Android ecosystem is looking to leverage more and more of. Look at the latest Samsung phones. They are targeting a lot of those Gen AI features, and Apple is really playing catch up over there, and they need to showcase that at the WWDC when they have all the developers over there.
Mandeep, this is something you think about a lot. So lay out the ultimate vision for us. What does Apple want its devices to be able to do for us from an AI perspective? Like how is it going to interact with me using AI?
I mean, the biggest kind of UI upgrade they can offer is around the Siri. You know, the fact that Siri is so underutilized right now as a voice assistant, if it has the right set of Gen AI features, clearly that will have a big influence on how we interact with the next version of the phones they make. And also, you know, some of the utility inside the app, like you don't have to, you know, kind of touch everything or do everything manually in terms of giving instructions. There is this concept of AI agents that has to be front and center in the next version of software that Apple offers within their operating system, so that AI agent can automate a lot of the tasks, not fully, but pieces of it, and you want to see Apple making progress on that front.
All right, Mandeep, thanks so much for joining us. Appreciate it. As always, Mandeep Singh, he's a senior technology analyst for Bloomberg Intelligence, giving us the latest. Again, Apple had their new product unveiling of the new Apple iPad. And I think what I've heard from Mandeep and Anurag Rana, also covers technology for Bloomberg Intelligence, is in terms of new product launches and refreshes, it's really just evolutionary. They just iterate on the margins as opposed to something really radically new that'll cause everybody to run out and buy a new product. Those days are probably behind Apple.
People have said that in the past, though, Paul. So I see where you're coming from, but there would be those people who said, you know what, they said that when Steve Jobs died, and look what's happened over the last 10 years. I will say, I think they need to move the AirPods from a hardware category to services, because I am just, it's like I need a subscription to these things because I lose them so much.
Yeah, exactly.
That's the issue.
Yeah, exactly. So, but it's interesting. So that's why, you know, if you do think that it's less of a product story, then you focus more on the services side of the business, which is about 20% of their revenue, and it's growing double digits, and it's a higher margin business, and that's a good story.
Gurman has talked to us about AirPods actually getting some AI features too.
Really? Okay.
Lenses, maybe. We'll see.
All right, we'll see how it goes. To me, if I'm an investor in Apple, it's just all about China. I'm concerned that the demand there for my products and services is going to be less going forward, and that's a concern. That's one of the concerns for the stock. We'll certainly keep on top of that. S&P up 0.2%. This is Bloomberg.
company news headlines on Bloomberg Radio.
And I'm John Tucker, the newsroom. Look at some of the companies we're following. Let's start off with electric utilities confronting the largest increase in demand in a generation. So you have data centers, they run artificial intelligence, and the grids being stressed by new factories, a wide-ranging electrification from cars to home heating. Duke Energy's now set up a new way to build these data centers and factories for electricity. It's the latest move by utilities to deal with the massive growth in energy demand. The utility began putting the rate structures into place for new customers late in the first quarter. This comes after Duke's hyperscale team studied how to make sure those users are shouldering their fair share of grid improvements and other costs. A part of the new structure would make customers pay for a set amount of power over a certain period of time, even if they use less. And the historic first crewed mission of Boeing's Starliner space capsule is now targeting launch as early as Friday. Of course, this follows the technical issue that prevented the initial launch on Monday. The Boeing-Lockheed Martin joint venture that makes the Atlas V rocket carrying the capsule halted the countdown after identifying unexpected behavior with a valve. The mission, this is key to proving that Boeing can transport humans safely to space, aims to travel to the International Space Station and back. And Panera Bread says it's discontinuing its charged sips. These have drawn lawsuits alleging the caffeinated drinks lead to health issues. To replace the drinks, the company plans to introduce new beverages in the next couple of weeks. Cafes being instructed to stop ordering the product to avoid having excess inventory. What, you use it?
No, but it reminds me of the Four Loko days.
Right. Anyway, that is your company news.
This is Bloomberg Intelligence with Alex Steele and Paul Sweeney on Bloomberg Radio.
All right, take a look at these markets. We have the S&P 500 up about 0.25%. The Nasdaq's up about 0.1%. 1%. Yields coming in about 5 basis points on your 10-year. We're now at 4.43%. WTI crude oil sitting right at $78 per barrel. Gold a little bit lower, $2,300 and $19 an ounce. And Bitcoin up 0.7%, 63,800 on the cryptocurrency. Quote that out there for Tom Keene. With our news in New York City, here's Michael Barr.
Thank you very much, Paul, Tim, and John. Porn star Stormy Daniels is testifying right now as a witness in Donald Trump's hush money trial. In the final weeks of Trump's 2016 Republican presidential campaign, his then lawyer, Michael Cohen, paid Daniels $130,000 to keep quiet about what she says was a sexual encounter with Trump in 2006. Trump denies that. Trump also denies falsifying business records in connection with the hush money payment. He spoke before heading into the courtroom this morning.
We didn't put it down as construction costs, the purchase of sheetrock, the electrical cost. The legal expense that we paid was put down as legal expense.
Trump also says he was recently told who the witness would be today and complains he should have been given more notice. Israeli tanks have seized control of Gaza's vital Rafah border crossing today as Israel brushed off urgent warnings from close allies and moved into the southern city. Yesterday, Hamas said it accepted an Egyptian-Qatari-mediated ceasefire proposal. Israel, however, insisted the deal did not meet its core demands. President Biden will denounce anti-Semitism at college campus protests against Israel when he addresses an annual Holocaust commemoration on Capitol Hill later this morning. Bloomberg's Jody Schneider reports this will be the second time he's addressed the turmoil at the schools across the country.
He did in his very limited remarks last week, after getting criticism for not addressing these protests on college campuses, he did come out and say that while peaceful protests were, of course, very American, once they got violent, and especially when they descended into hate speech, they were not something that he would support.
Bloomberg's Jody Schneider reports the president will recount the October 7th Hamas assault on Israel as the deadliest attack on Jews since the Nazi genocide in World War II. Global news 24 hours a day and whenever you want it with Bloomberg News Now. I'm Michael Barr, and this is Bloomberg. Paul, Tim, and now Charlie.
All right, very good. Michael Barr, I got a story from Michael Barr and for all these big players out there. For all the talk big money exodus from New York, the city's residents still have more wealth in excess of $3 trillion than those of any other metro in the world. New York has almost 350,000 millionaires, which is the most of any city, and up 48% from a decade ago, according to a global ranking of the wealthiest cities by Henley and Partners, an immigration consultancy. That means about 1 in every 24 of its 8.26 million residents has a 7-figure net worth, compared to about 1 in 36 in 2013. So you're part of an elite group there, Michael Barr.
Yeah, I guess I'm number 8 because I missed the whole thing. I didn't hit 24.
Well, maybe this'll help. We still have a large share in New York of the ultra rich too. There's 60 billionaires and 744 people with investable wealth of more than $100 million. So if you're not, just a millionaire, you could be a 100 millionaire or a billionaire.
Well, forgive me for saying it like this, but I'm pretty doggone sure I'm not even in that one, man. If you had one where there was the dude that had a loaf of bread and a tiger's cap, that's me.
That's you. All right. All right. The findings illustrate the scope of New York's wealth at a time when some of the city's richest people are fretting a power shift to Florida as the finance industry sets up a Wall Street South. Miami ranked 33rd among the cities with the most millionaires, up 78% over the past 10 years. The Bay Area came in second overall with 305,000 people with 7-figure net worth. And that area includes San Jose, San Francisco, and Palo Alto. So that's a pretty good place to be as well. Markets here up fractionally. The S&P up about 0.3%. NASDAQ up about 0.2%. We're going to have more coming up. This is Bloomberg. Good morning.
This is Bloomberg Intelligence with Alex Steele and Paul Sweeney.
The real outperformance has been the U.S. corporate high yield.
Are the companies lean enough? Have they trimmed all the fat?
The semiconductor business is a really cyclical business.
Breaking market headlines and corporate news from across the globe.
Do investors like the M&A that we've seen?
These are two big-time blue-chip companies.
The window between the peak and cut changing super fast.
Bloomberg Intelligence with Alex Steele and Paul Sweeney on Bloomberg Radio.
All right, coming up in this hour, we're going to check in with John Mendick. He is the CEO of Urban Green Council to discuss pressures to phase out natural gas. Allison Williams is going to join us, Bloomberg Intelligence. She covers all the banks for us. Not surprisingly, one of the most read stories on the Bloomberg terminal is bonuses seen soaring for bond desk traders in early prediction. Always gets a lot of readership on the Bloomberg terminal. We talk about pay on Wall Street, so we'll check in with Allison on that. Let's kick everything off this hour like we like to do with Mr. Charlie Pellet of Bloomberg Business Flash.
The Dow, the S&P, NASDAQ all advancing. Best level of the day right now on the S&P 500 index. This update brought to you by BNY Mellon Insight. June 4th to the 6th in Nashville, Tennessee. Don't miss the essential event for the financial advice community. Visit insight.bnymellon.com. Stocks at the highs of the morning right now with the S&P up 15, 51.96, up 0.3%. We have got the Dow up 110 points, up 0.3%. NASDAQ up 32, higher by 0.2%. And should also point out that the S&P is close to its highest level in just about 1 month. So the 10-year, 4.43%. The 2-year right now, 4.80%. Gold is retreating by just about $6 the ounce, 23.17 right now, down by about 0.2%. And West Texas Intermediate crude down 0.6%, 78 even a barrel for WTI. As for the Federal Reserve and the rate-cutting outlook, Frances Donald is Global Chief Economist at Manulife Asset Management, and she was the guest this morning right here on Bloomberg Intelligence.
We do expect the labor market in particular to decline. We do expect inflation to decline, but we have a few more months before the data will give the Fed permission to begin this easing cycle.
Frances Donald of Manulife, a guest here on Bloomberg Intelligence. Disney shares lower after the world's biggest entertainment company reported subscribers for its Disney Plus streaming service were lower than analysts expected, and a profit outlook for the year also came up short. Disney right now lower by 9.3%. Also reporting earnings, also moving lower, Palantir Technologies. Some investors unimpressed by the company's outlook for annual sales after the stock already tripled in the past year. Palantir right now down by 14.2%. Recapping stocks higher, S&P up 15, up 0.3%. I'm Charlie Pelleton. That is a Bloomberg Business Flash.
All right, Charlie Pellet, thank you so much. We appreciate it. Tim Stenvik, he's sitting in for Alex Steele today. I'm Paul Sweeney. We're live here in our Bloomberg Interactive Broker Studio. We're streaming live on YouTube as well. So head over there and search Bloomberg Podcast, and that's where you will find us here. As Charlie's just reporting a little bit of a lift here to the market. Let's see where the action is under the hood. We got a lot of companies reporting earnings, a lot of stories out there, maybe even a little M&A out there as well. Nora Melinda joins us. She covers all of the equities for Bloomberg News. Nora, what do you have for us?
Let's take a look at Tesla. So Tesla shares are slipping as much as 3.6% in trading this morning. Now, this is coming after preliminary data from China's Passenger Car Association that showed that shipments from its Shanghai factory dropped 18% year on year last month. And so, of course, we did see also total shipments falling 30% from March to 62,167 units in April. So this has the company pulling back a little bit of a dip. Of course, we do know that Tesla is still down about 28% year to date.
Yeah, I don't know what the play is there in China. It's for a lot of companies, but certainly they have a big exposure there as well.
Definitely.
What else you got? Oh, builders.
Yes.
No surprise, because you cover the real estate industry.
My
one of your
favorites.
Yes. Okay.
Yes, so I cover real estate stocks, home builders in particular, as well as REITs. I'm looking at Builders First Source. Now, that's ticker BLDR. It's actually the biggest laggard in the S&P 500 right now by percentage. And this is coming after it is falling for its biggest drop in 4 years. Its earnings highlighted that there are continued headwinds from a weakening apartment market as well as higher mortgage rates. We know that this has been pretty stubborn, especially when you think about across the whole real estate landscape, but this is specifically a home builder products distributor. So, of course, if home builders, and we're seeing a lot of stuff and issues within the real estate market in the apartment space, of course, you're going to see its distributor dealing with some issues as well. Specifically on the earnings call this morning, it said it expects another big decline in the second quarter in multifamily and sees a consistent year-over-year decline through the end of this year. Shares are up about 1%.
I thought we had a housing shortage in this country.
Yeah. Right, don't we? We do, we do. It's funny how these two things are
How do we
happening
have
at
a
the same
housing
time.
shortage? I mean, our population's not growing that.
Oh, well, a lot of first-time homeowners are, doing household formation now. So it's like, it used to be millennials. Now it's like elder millennials who want to buy their first home who can't afford it. And then, even younger people who are like, okay, well, yeah, I was single. Now I have a partner. We want to have kids. We want to get a home.
Right.
And
Ready to
it's just so
settle down.
expensive. Yeah.
Right. And nobody's moving out of their existing house because the mortgage rates are 7.25%.
It's a lockup.
What is Maple Bear?
See, I think that's the funniest
I love
name.
it. It's great.
Can
It's
someone
great.
please tell me where did that come from, Maple Bear? But
There's a story behind it, but
I'm
I
sure.
forgot.
I mean, I got a
It's
great
like
product,
something that has to
Instacart,
do with Vermont,
which
I don't
which
know.
lends itself to a great ticker symbol for the stock, which is a former banker. I get paid to come up with these tickers. CART, perfect.
that made sense.
Maple
that
Bear.
made
Go ahead.
sense.
What's happening?
But
out
we're
there?
looking at basically Instacart. That's ticker, as you said, CART. We're seeing those shares up as much as 4%. Now, this is after the news that it's going to be partnering with Uber to offer restaurant delivery through its app. And it's going to be rivaling DoorDash through this. We actually heard the Uber CEO flicking at this. She said, quote, you could say that we're a threat to DoorDash, both independently and teaming up as well. So she has a lot of faith not only in Uber, but also Instacart through this collaboration. But one thing that I found pretty interesting, I didn't realize that DoorDash makes up 67% share of the U.S. food delivery market. I'm a Grubhub user. And so I didn't realize
I'm an adult.
that.
I walk to the store.
Yeah, there it is.
I'm lazy. I get everything delivered from groceries.
But you also make your own pizza at home, so that's what I'm learning about.
This is what
so you're not lazy.
I pay for my kids' education.
Yeah.
Pay the health care. Pay the insurance.
Yeah, they're grateful, Paul.
My
okay?
youngest, he did this once. He'll never do it again. He's in college. He put DoorDash on the credit card,
Ooh.
and I shut the credit card off for a week.
Yeah, that's an emergency credit card, and that wasn't an emergency.
No, and I mean it was a $15 McDonald's order, and then it comes up and it's like $30. I'm like,
probably.
Sweeney's do not do that stuff. We walk to this, we drive, we make it. I mean, I think that is such a scam. Yet your generation.
I mean,
you sound like an elder Stenovic, Sweeney.
Yep. it's such a scam. I can't people do it, but they do it. It's a good business. CART, C-A-R-T. All right, Norma Linda, thanks so much. We appreciate that.
Don't worry. Wikipedia coming up big on Maple Bear. Okay, according to Wikipedia, the company's name is a combination of maple in reference to Canada and bear for the logo on the California state flag.
The more you know.
Yeah, Maple Bear.
I think I would have just called it.
I'm citing Wikipedia here, guys.
Tom Keene is all about Wikipedia. John Mandyke joins us here because we're going to shift gears. He's the Chief Executive Officer of Urban Green Council. He joins us here in our Bloomberg Interactive Broker Studio. Welcome for coming in. You get extra points for not mailing it in. Electrification of buildings. How do we power our buildings today?
Well, in New York City, the largest source of carbon comes from furnaces, boilers, and hot water heaters. It's natural gas in the basement for heat and hot water.
Okay.
So that's our largest source of carbon. That's our biggest.
I thought natural gas was clean burning energy.
Well, it was compared to coal.
Okay, but that's still not good enough.
But it's not good enough.
Okay.
Okay, so I recently moved from a hybrid electric-powered and gas-powered home, where gas did our hot water and our stove and oven, into an all-electric place. And here's what happened. The oven doesn't work very well. The stove works incredibly well because it's induction. The hot water heaters, it's kind of okay. Our electric bill is huge, but we got no gas bill. Our electric bill is so much now. It's more than it was before with gas added.
Right. Well, there are artificial incentives built in the system for natural gas, and those are starting to be addressed. For example, in New York State, if you're within 100 feet of a gas line, you can demand to have service, and everybody pays for that.
Wow.
And so we have to get to where electricity has the true price and gas has the true price, and so those two can compete. And over time, with conflicts around the world and where we see climate policies going, there's going to be a carbon price built into natural gas.
Okay.
Well, how do we most efficiently electrify a building?
Right. Well, we do it by installing heat pumps for heat and hot water, and that's the main way to do it. In New York, like I said, our problem isn't lighting. Our problem is the heating and hot water. Then, of course, you need the grid to green at the same time, and that's happening as well.
Is an electric-powered hot water heater more or less efficient than a gas-powered hot water heater? Same with like a dryer, for example, because you can get a dryer that's has a gas-heated element, but in these newer buildings where they don't allow gas, you're stuck with electric. Is it as efficient?
Right, and they're getting efficient for sure, and they're getting to parity.
The heat pump works really well.
The heat pump is very efficient. It can be way more efficient than the natural gas boiler or furnace that you already have.
What about when it comes to the other appliances, though?
They're getting there, and
but not yet.
Hot water. No, there are hot water systems that are there.
Okay.
And we need more technology to come on board when it comes to hot water, particularly to scale across all the different type of building types and cities. But we have the largest decarbonization market in the world now in New York City, and that's going to spur innovation to help serve this market.
The thing that's a challenge to me when thinking about this, and look, no question, I want to do what's right for the environment, what's right for the world. Where is this power being generated? Because it's not being generated at Indian Point anymore. That's shut down, so it's not nuclear. Here in New York City, we're still relying on a lot of dirty sources to power. So whether or not we're heating with gas or electricity, net doesn't really matter if that electricity is generated by a dirty source.
It does, because today's heat pumps are so more energy efficient that you're just using less energy, which means you're using less carbon, and it almost doesn't matter what the grid is, right? But at that same time, the grid is greening in New York, right? We did lose Indian Point. That was about a third of our power in New York City. That was fossil fuel free. That's being replaced by hydropower and renewable power that's coming in as soon as 2026. So the grid is greening, and that's going to help when we start to plug more things into that grid.
Is the grid, like I read the book, The Grid. There is a book out there, and I have John Tucker reading it now, and it talks about the history of electricity in this country, which is fascinating. I look like a geek sitting on the Jersey Shore 2 summers ago.
I feel like I got to read that. I got to read this book.
It's no way to pick up girls, I think, reading the book about the grid, Can our grid today handle increased electrical demand?
It can for heating, right?
Okay.
So our organization modeled all 1 million buildings in New York City against the local Con Edison grid. What we found is there's a 42% headroom in the winter to plug things into the grid. So said a different way, our grid is built out for the hottest day of the year, right? And when we turn those air conditioners off, 42% of our grid goes dormant. It's actually a very inefficient use of assets. So there's 42% room to plug stuff into the grid because our heating source is not electrical based today, it's fossil fuel based.
So what would you say is the biggest thing holding us back when it comes to wide-scale adoption of more electricity and less gas? Is it because these legacy systems